They need to gather in the room and think hard about, do we want to go towards 25 or 50?
I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case.
They don't want any more cooling in the labor market. So that's the argument for a 50 now. Quickly get us to neutral.
You cut 50 if you think there's a recession, but if you don't think there's a recession, you probably want to cut at a more gradual pace.
Animal spirits are alive and well, and the Fed has to be careful about that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday on a 4-day losing streak on the S&P 500 following an indecisive jobs number on Friday, hoping to leave behind the worst week of the year so far on the S&P 500. Equity futures bouncing just a touch. On the S&P 500, positive by 0.7%. On the Nasdaq 100, positive 0.9%. This week, the focus shifts from one side of the mandate to the other. CPI and PPI, Lisa, just around a corner.
Key question to me is how much it matters. A lot of people saying the employment mandate very much front and center. However, I was thinking about this a lot over the weekend. Essentially, if we get a much softer than expected CPI print, how much does this open the door for the Fed to be even greater in terms of their accommodation, just simply because that is not a pressure still very much on the table?
The Fed goes into the quiet period now. No more Fed speak. Governor Waller closed that up on Friday. I still just think there's a little bit of daylight between where investors are and where Fed speakers are. And I think the way they look at the labour market is just a little bit different as well. For investors, I think they look at the labour market right now as guilty until proven innocent. And I think for officials on the FOMC, they see it as innocent until proven guilty, which is why the market's still at, say, let's go 50, we need to go 50. And market participants are looking at the Fed, who are basically telling them, I think the base case is still 25.
Basically, across the board, every single note that I read over the weekend said 25 is the base case. But then when you look a little bit deeper, they're actually all saying the same thing, from Chris Waller to Seth Carpenter over at Morgan Stanley, which is the risks are skewed materially to the downside, and it just takes a little bit more information, to your point, to sort of prove the guiltiness of this labor market. And that is the feeling that you get. I do see some downside risk to employment that I'll be watching closely. Governor Waller, Seth Carpenter, our read of the jobs report sees heightened risks that the slowdown will be more than our baseline assumes. That is the anxiety underpinning market movements.
So we've got CPI and PPI teeing us up for a Fed decision on September 18th. And then after September 18th, the only thing we'll be talking about is the election in early November. There is a big debate in the next 24 hours. We're all sitting here hoping we get some clarity on policy. Listening to the former President Donald Trump over the weekend, I have to say, I've got anything but clarity on policy. What's the new tariff push now? Have we got any detail on what that policy actually is?
Not a ton of detail, though I did speak to an individual close to the former president over the weekend about what he means when he says he's going to go after individuals who are basically not using the dollar. Basically, those that have a trade surplus with the United States but are lessening their dollar holdings. They're trying to shrink their dollar holdings, i.e. China. Potentially they would use tariffs, or maybe other countries in the BRICS, or maybe some of those individuals in the Gulf. Donald Trump loves to use tariffs. He talked about this last week at the Economic Club of New York. It's one of those levers. Others I talked to about say that, Trump says he's going to use tariffs as a way to start in the negotiating process. Maybe it's not going to be where it ends.
This highlights to me the confusion of what do you listen to. I'm old enough to remember when he was talking about the importance of not having a dollar that is too strong. And then you have this idea of people who move away from the dollar, which would allow it to be weaker, actually being persecuted, being tariffed 100%. This raises the question, what do you listen to? Which Donald Trump are we going to get? Which Donald Trump is the one who's trying to cater to the base that he's looking for? And to me, I think it's important to listen to the messaging. Right now, tariffs are taking the preeminence over the dollar. That might be the tone heading into some of these debates. And frankly, when I talk to businesses, they care about that more than most other things.
There's some contradictions we need to work through for the next hour, and we'll do our best to do so. If you are just joining us, welcome to the programme. Equity futures on the S&P 500 with a bounce up by 0.75%. In the bond market, yields higher by 5 basis points on a 10-year, 375.51. We'll talk about what's happening with the yield curve as well. 2s versus 10s, the first positive close on the yield curve going back to 2022. And another bounce we need to focus on as well. Crude back at 68, up by 1%. On Friday, a 5-day losing streak. On Friday, we closed out the week. Lisa down by almost 8% on WTI crude.
Going to the lowest level since 2021. To me, this raises a real question at a time where you're not just seeing it in the oil space, you're also seeing it in the copper, you're also seeing it in the iron ore. And to me, that's my big concern. At what point are we seeing demand rolling over? And we're seeing that from China. We're seeing that even Japan coming off just a little bit. What are the pillars holding up this economy?
Commodities have had a really tough time. Coming up on this program this hour, we'll catch up with Joe Quinlan of Merrill Bank of America Private Bank ahead of CPI data this week, Congressman French Hill as Donald Trump doubles down on tariffs, and Nela Richardson of ADP on the American jobs market. We begin with our top story. Stocks looking to rebound after the S&P 500 suffered its worst week of 2024. Joe Quinlan of Merrill Bank of America Private Bank is still bullish. We maintain an overweight to equities with a preference for higher quality US large and small caps. The productive capacity and wealth of the US keeps us bullish on US assets as core holdings. Joe kicks off the week with us right now. Joe, welcome back to the program. What I hear from you is you are unwilling to fade US exceptionalism. Is that fair? And ultimately explain to us why.
That is fair, John, for sure. We are in the camp that we get 25 basis point cut in September, but really, the 50 or 25, that misses the point that this U.S. economy, most diverse dynamic in the world, you're seeing the demand for U.S. securities overseas. So, I know we get caught up in the moment, CPI, we've got the debate, we've got the election, but on the other side of the election, we're going to continue to grow. AI productivity is going to kick in, help drive the U.S. economy. So I wouldn't call it exceptionalism, so to speak, but when you look at relatively speaking, we're out in front of the United States. We see that continuing.
So, Joe, explain why the equity market is trading so poorly at the moment, worst week of the year. Explain why the dollar has been on such a losing streak over the last few months. What backs that up?
I mean, John, we know September is very rude to the markets, to investors. October will be choppy as well. So we've got some seasonality. We've got some pullback here with the mega tech. We're seeing a lot of our clients just happy in the money market funds. So we've got $6 trillion sitting there as well. I think the dollar weakness here a little bit, that's in and around investors, foreign investors, worried about what you just talked about, tariffs. What does that mean? What does it mean for more protectionism? So I think some of the foreign investors, remember, they own around 28% of U.S. Treasuries. They own around 20% of equities. They have an indirect vote. So some of this dollar weakness, I think, is foreign investors repositioning ahead of a U.S. that's more nationalist and more protectionist.
We've heard a lot from people who say volatility is something you want to lean into and take advantage of because they have a bullish view, just like yourself, on the U.S. economy and U.S. exceptionalism. If that's the case, how much conviction do you have to lean against the sort of seasonal weakness that some people say we're seeing right now?
I mean, Lisa, we have high conviction. We put out a note, the CIO, on Friday saying on these pullbacks between now and the election, step in, buy the pullbacks. High quality, large cap, small cap, really all styles. So that's our preference, and that's our call. That we expect this volatility, right? If any investors in the market right now not expecting volatility, they're missing the opportunity to add quality to rebalance their portfolio. So we're leaning into the volatility.
Joe, what would you have to see in the economic data to confirm that, given the fact that you have Chris Waller coming out and saying, in general, they're still positive, but they do see risks to the downside? You're hearing similar types of commentary coming throughout Wall Street analysts.
Lisa, I mean, I see the economy slowing, not stalling. So 4.2% unemployment rate, that's pretty good, relatively speaking. We saw female participation rates all-time high. College-educated workers with a 4-year degree or more, the unemployment rate's 2.5. So we're still convinced that the consumer-led economy continues to chug along. It's slowing, not stalling. I think this is a head fake, the worries around the recession. Maybe we're going to have a recession someday, of course, down the road, for sure. We just don't think the markets right now needs to price that in.
Well, down the road, as in next year, and what pushes the U.S. into a recession?
Great question, Emery. What could push us into a recession? Suppose we have an election that is not settled by the end, and say November 5th. Suppose we have a pullback following that. So it's going to be a policy errors. Recessions come from policy errors. Think of it that way. So whether it's protectionism, whether it's the tariffs, whether it's immigration, whether it's overseas, some geopolitical event, that's how it's going to happen. So the recessions typically revolve around policy errors. And we think the Fed has done a good job. I mean, remember, 2 years ago, we're talking about a CPI print coming down from 9%. Now we're below 3%. So we're not done. Maybe a lot of the markets are saying the Fed's behind the curve. We don't believe that, but recessions come from policy errors.
You mentioned protectionism a number of times and how potentially investors abroad are more worried about a more protectionist United States. Does that change whether we get Donald Trump or Kamala Harris?
Good question. We'll see. What you talked about earlier, the platforms. We need more policy meat on the bones here for investors to realize, okay, Democrats or Republicans. So yes, that is an ongoing issue with our clients. When you go out to talk to the manufacturers, you talk to a lot of small businesses, they are worried about the tariffs, protectionism. They're worried about trade relations. And I overlay that protection with immigration. I mean, that's a big point of contention for a lot of U.S. companies in terms of that's their key in terms of many cases for labor growth. So yes, protectionism is front in mind and the costs that are associated with. Protectionism typically is inflationary, and now we're moving to deflation that could reverse that policy where we're headed, and that could be upsetting to the markets.
Hey, Joe, we've got to leave it there. Joe Quinlan there of Merrill Bank of America Private Bank on this equity market. Still bullish, still long so-called US exceptionalism. Jim Bianco of Bianco Research on with us a little bit later. In line with some of this thinking that we heard from Torsten Slock of Apollo on Friday following the number, which was basically head fake, nothing to see here. Things are okay in the labour market.
Saying that he's in the no landing camp, where basically the Fed doesn't need to do that much. Ed Yardeni, who's also going to be on with us, a similar kind of tone. Question that I have is, when you talk about the balance of risks, and when you hear Joe Quinlan talking about a Fed mistake or a policy error, what is it? What is the more likely error? Them going by 50 basis points or them going by 25 basis points? Them moving more quickly and aggressively and allowing the market to rally, or them holding back? I don't think anyone knows the answer to that as much as people are sounding convicted.
Based on the price action in the bond market, it's pretty clear what the bond market expects. Correct. The big bull steepener, an aggressive move at a front end, right? A front loading at a series of rate cuts from the FOMC.
That's why I think this Wednesday is going to be really interesting. We have a CPI print that's coming out at a time when if inflation's coming in a lot lower, then that means, theoretically, if you extrapolate it out, this is a much more restrictive Federal Reserve. And maybe they have more room to cut rates without talking about this having to do with the labor market as much as the appropriate policy for this particular go-around.
For the first time in a long time, it really feels like September 18th. The next Fed decision is a game-time decision. The committee really hasn't decided 25 or 50. I still say, and others have said this too, that Chairman Powell's speech at the end of August felt like a 50 basis point rate cut speech. FOMC officials since Chairman Powell and Jackson Hole haven't exactly backed that up.
No, in fact, 25 basis points seems about right. They talk about the soft landing. They talk about the need not to go too far. However, completely hedged. And I think this is important to note because Chris Waller really came out and talked about the even balance of risks, how they don't want to allow the economy to get too hot, but they're also very aware of the potential for downside risks. Really, it's a knife's edge. I mean, not data point necessarily dependent, however, on the margins, data point dependent.
Bonds down, yields up by 5 across the yield curve this morning. Equity futures up by 0.8% as well. Let's take the opportunity to get you some stories from elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Venezuela's opposition leader Edmundo Gonzalez has been granted political asylum in Spain, fleeing to avoid arrest. A month ago, the opposition presented voting records they say prove Gonzalez won the July 28th presidential election. But Venezuelan authorities said Nicolas Maduro was reelected to a third term and ordered Gonzalez's arrest. Couche-Tard has reaffirmed its interest in 7 & I. The Japanese owner of 7-Eleven had rejected its $39 billion initial acquisition bid. Couche-Tard says it wants to work with 7 & I to agree on a friendly buyout. A deal would be the biggest ever foreign takeover of a Japanese company. And Boeing's Starliner spacecraft returned to Earth without its astronauts this weekend. The capsule left the International Space Station at 6:04 p.m. Eastern Friday night. It landed in White Sands, New Mexico after a 6-hour flight. The astronauts, Butch Wilmore and Suni Williams, were left behind. The pair were originally set to come home in the Starliner after 10 days, but will remain until February 2025 when a SpaceX craft will carry them home. And that's your brief, John.
Still shaking my head about this story. Danny, thank you. More from Danny in 30 minutes' time. Just shocking. Unbelievable.
She looked happy. She looked like she was having a good time in space.
I'm not sure when those pictures were taken.
Maybe it's really fun. You know, I've always wanted to have zero gravity.
You think those pictures were taken in the immediate aftermath of being told you're not coming back until February?
Maybe they're, issues.
I'm not.
Okay, that's
Don't know
terrible.
about that.
You're right. Correct.
Up next on the program, Donald Trump, the tariff man.
In the words of a very great but highly underrated president, William McKinley, I am a tariff man standing on a tariff platform.
That conversation up next. From New York City this morning, good morning. Live from New York City, welcome to the program. Your scores look like this Monday morning. Good morning to you. Equity futures positive 0.8%, unwinding some of the losses from Friday's session. Yields higher as well, much lower again last week, particularly on the front end of the curve. Up this morning by 5 basis points, 375.51. Under surveillance this morning, Donald Trump, the tariff man.
In the words of a very great but highly underrated president, William McKinley, I am a tariff man standing on a tariff platform, and we will keep the U.S. dollar as the world's reserve currency, and it is currently under major siege. Many countries are leaving the dollar. They're not going to leave the dollar with me. I'll say, you leave the dollar. You're not doing business with the United States because we're going to put 100% tariff on your goods.
So here's the latest. Republican presidential nominee Donald Trump threatening 100% tariffs on countries who shift away from the US dollar. The comments coming at a rally in the battleground state of Wisconsin. The latest polling showing the race in a dead heat, with momentum beginning to shift in the former president's favor. Joining us now around the table, Congressman French Hill of Arkansas. Congressman, good to see you, sir. Good morning.
Jonathan, great to be with you.
I know you're in town for the Barclays Global Financial Services Conference, and we can talk about regulation a little bit later. First of all, the big challenge. Can you translate that? Was that vibes or policy? Because that's been the criticism of the other side. What was that?
I think it's President Trump having a good time at a rally. Because back when William McKinley was president, of course, we financed the whole federal government through tariffs. That was the principal source of federal revenue. I don't think that's a relevant issue. I think the biggest risk to the dollar, being the principal reserve currency of the world, is really our own fiscal situation. We're not going to be supplanted by a group of countries who want to replace the dollar, in my view. Instead, the biggest risk is our own sustainable fiscal situation.
Do you see an agenda, a campaign that's willing to address that on the Republican side?
Well, I don't see an agenda to address that in either political party. It's been concerning to a lot of members of Congress because to get our country in a sustainable fiscal situation, we need to make long-term reforms to our mandatory spending programs, such as veterans benefits or Social Security or Medicare, and healthcare costs drive a lot of that non-sustainable finance. But that can only be done, on a bipartisan basis. And it's been attempted on and off for 40 years with really only one material change, which was Ronald Reagan's work with then Democratic Speaker Tip O'Neill to reform Social Security back in '83 and '84. But it's that kind of targeted bipartisan approach I think we need. And all we're doing is trying to lower the growth rate of those programs over a long term because we have the best economy, the best rule of law system, the best litigation and legal court system in the world, and we have the best banking and capital market system in the world. Those are all indicia of a good reserve currency, but you also want global confidence and domestic confidence in a long-term sustainable fiscal situation.
Speaking of confidence, are you confident that the government will not shut down? We're facing a government shutdown September 30th, and you'll be back in D.C. for about 3 weeks. Right. That's it, to really hammer this out.
Well, Anne-Marie, I am confident that we won't have a government shutdown because we're just a few weeks away from a national election, and I don't think that benefits anybody running for re-election. So I think we will navigate the need for a continuing resolution to get fiscal 25 spending moved to beyond the election. And in the House, we've gotten 70% of funding passed and across the House floor. Over in the Senate, they've not gotten across the Senate floor spending, so we're going to be confronted with a CR, but I do think we'll get that done before September 30th.
I guess my question is then, is this a CR that's clean? Because Schumer put out a Dear Colleague letter last night talking about the fact that there can't be any poison pills in it. Will it be a clean CR that Republicans and Democrats can agree to as just basically funding the government until the end of the year?
That may be ultimately what happens, but I think Speaker Johnson's proposed that we do a clean CR with 3 additions. One, some disaster money that's needed, some 2 Virginia-class submarines be added into it. And then finally, the SAVE Act, which would be a Republican proposal, would pass the House with bipartisan support, reminding states that only citizens can vote in federal elections and giving the states some guidance on how to make sure that's the case. With nearly 10 million people in the country, a huge majority of which are not citizens, audits have found some non-citizens attempting to vote in federal elections. It's a big issue. When I was home in Arkansas just the last few weeks, it came up at time and time again at events that I went to. So people are concerned about that. Speaker Johnson proposes that we put that bill, the SAVE Act, attached to the CR.
Yeah, it doesn't look like the Senate's willing to take that up. Given the fact that after this it's going to be all about politics, what are you and your colleagues discussing when you look down ballot? The fact that Democrats are just absolutely trouncing Republicans when it comes to fundraising, especially in the House.
Well, our candidates, both our challengers and our incumbents, had excellent hard money fundraising up until the summer. So they were leading their Democratic opponents across the board through the summer fundraising. So I think that first 18 months of the cycle, I think our incumbents and our challengers did very, very well. Democrats have had some momentum in the last few weeks to catch up, but now the rubber's hitting the road. And I think we've got adequate funding in the House to hold the House, pick up seats, and I feel optimistic about the Senate as well.
You were talking about the deficit and how that's your biggest concern, more than, say, countries that are looking for alternatives to the dollar. Do you think that this country can afford a 15% corporate tax rate, given the fact that already we're kind of struggling to bridge that gap?
Well, look, when we come into session in the 119th Congress next year, we've got some real challenges. We've got 2 big, I think, fiscal red blinking lights on the dashboard of the Congress. First, Tax Cuts and Jobs Act rates and policies are going to expire during the year. And secondly, we're coming into yet another Congress with a $2 trillion annualized deficit forecast. So Congress has hard work. And Jason Smith, who's our Ways and Means Committee chair, has got the point on how do we preserve growth in this environment and how do we set rates that reflect the growth that we need, the faster economic growth and productivity that we want, fairness for small businesses, but recognize that we're confronting this big deficit.
Do you think that it's appropriate for the Federal Reserve to lower rates to make the deficit more affordable in sort of a policy shift, even if that means that inflation runs a little bit hotter?
I don't think that's the Fed's job. I think the Fed's job is price stability. I don't think the Fed's job is to do that. It has in the past, since 1913. We've had the Fed and the Treasury work in cahoots to lower borrowing costs during World War II, for example. But I think in a modern context, the Fed's principal mission is price stability.
We know you've got places to be. One of those places this morning is over at Barclays at the Global Financial Services Conference. Walk us through what should be top of the regulatory agenda in the next term, for the next 4 years maybe, headed up by, say, Donald Trump in the White House and maybe you at the head of the Financial Services Committee.
Yeah. Well, I think we want to have access to capital as the number one issue. We want a very successful continuation of our capital market system, raising capital through the capital markets, but also we want a banking system that has affordable credit and accessible credit. And part of that is over the last decade or so since the financial crisis, we just have added on more regulatory costs in both the portfolio commercial banking sector and in the capital market sector that I don't believe improve safety and soundness and are a detriment to more competition in accessing capital. And so I think that's the principal mission.
We've got a lot to talk about. I know you've got to run, but it's good to see you, sir.
Great to
here
see
in
you,
New York City. Thank you very
me.
much. Thank you. French Hill there, the congressman from Arkansas on the regulatory agenda and the push on the deficit. And the push on the deficit is something we do not hear on a campaign trail in any way, shape or form.
It's not popular to pay your bills. It's not popular to pay your bills at the expense of programs that you really like or having to pay more. And that's really the challenge. And it's the challenge on both sides. And at a certain point, though, the rubber meets the road.
Coming up on this programme, more on that front and this. Steve Englander of Standard Chartered saying the appetite for risk can make a comeback. More on the FX market in just a moment. On the S&P 500, equities making a comeback, up by 0.75% from New York. You're watching Bloomberg TV. 4-day slide on the S&P 500. Equities bounce back 0.8% on the S&P. On the Nasdaq 100, positive by almost 1 full percentage point. On a Russell, the small caps lag up by 0.2%. Last week, the biggest one-week loss on the S&P 500 going back to the bank stress, the bank failures of March 2023. Switch on the board and turn the page and get to the bond market and just check out the difference between a 2-year and a 10-year. Both up by 4 to 5 basis points, both maturities this morning. The 2-year yielding 369.57, the 10-year at 375.32. This yield curve is normalizing. The difference is positive, and we closed there for the first time in about 2 years on Friday's session.
The answer, or really the main question that people have been asking has been, what does this mean? Is this actually a sign of some impending doom? Because usually when a curve disinverts after a long period of inversion, that typically means recession. Or is this a sign that people believe that this Federal Reserve will cut rates enough to stave off a recession? A lot of people leaning into that idea. We'll see.
We're at 550. Market pricing suggesting we're coming back down to something in the 3s. Priya Misra of JP Morgan Asset Management has sat around this table a few times and suggested you don't need a recession for that. That is just back towards the lower end of estimates of neutral at the Federal Reserve.
This to me, and I was quite passionate about this at the end of last week, and partly because
just a little bit passionate.
I can bring it back. Don't make me.
The heat.
Don't make me. I will do it. There is this question around whether we are seeing a fundamentally higher neutral rate now post-pandemic than we did pre-pandemic. And it seems like the answer is not necessarily. And people have been adjusting to that view after saying for many, many months, maybe we're looking at a 4% neutral rate, even 5% neutral rate. We don't hear those people talking about that anymore.
Look out for an update on September 18th of the summary of economic projections. The dot plot's going to be one to watch. Let's just park the bond market, turn a page to the commodity market and look at crude. Not so much the move this morning. The levels we're down to now. Low 70s on Brent, high 60s on WTI. 5-day losing streak on WTI crude last week. WTI had a weekly loss of almost 8% on WTI crude. Last week was brutal for commodities, including crude.
Yeah, Jim Reed pointing out that Brent crude oil prices ended the week at their lowest closing level going back to December of 2021, pointing out that essentially this came as OPEC Plus was forced to curtail their increase in production. My question is, how much of this is entirely China? We saw sort of almost on the verge of disinflation over in China. How much is this having to do with Europe and what we're seeing in Germany? And how much is this global and something that also is infecting the United States at a time when people are wondering if the labor market is rolling over? And that is sort of adding to the sort of angst behind the numbers that we saw on Friday.
OPEC right now is just deciding to not add to the barrels. But I think a bigger question is, are they going to have to cut to maintain these prices? You look at what the Vitol CEO, Russell Hardy, had to say to Bloomberg overnight. We are going to see supply. No one in the market is worried about supply in 2025 or 2026. So if you're OPEC and you're looking at that, and you see the United States pumping more than 13 million barrels a day, you're probably a little bit concerned that you actually might have to start cutting into next year.
China, a major piece of this puddle. WTI right now, 68.13. Under surveillance this morning, Apple preparing to roll out the iPhone 16 at an event later on today. The company also expected to reveal major updates to both the Apple Watch and AirPods and set the stage for its new suite of AI tools. The stock is up by, let's call it 0.6% in the pre-market. Lisa, I think this is a big one for the whole AI ecosystem. Demonstrate the use case for the smartphone. How do they convey that in the next 12 hours?
And demonstrate the price tag necessary for that. A lot of people looking at whether Apple increases the prices. Typically, they've tried to keep them the same to bring in a number of customers. If they raise prices and roll out a suite of a phone that will cook your dinner for you and mend your kids' clothes, then I think that you will see sort of a curious action in markets that want to see those margins increase. They want to see prices increase in tandem with that. Key question for me, John, and I think that everybody really wants to know, will Jonathan Ferro decide to upgrade as a result of the upgrades that we get unveiled at 1 p.m. today?
Let's see what we get. I'll give you an answer tomorrow morning.
That will be what everybody's waiting for.
I'm tempted I might be.
Really?
I've brought a phone charger to work, so now I'm just constantly charged. So that's like my hack. My technological hack is just to bring the charger everywhere with me.
Okay, hold
just
up.
Plug in the phone.
And there's portable chargers.
Wait, no, pause.
Right?
Just get a power bank.
You've got a portable charger, right? Is that
everywhere.
What you do? Yeah, there you go.
Okay,
there you go.
Power banks everywhere.
How long do you guys have a charge? Does that just mean that your phone has about 20 minutes before it dies?
No, I think it lasts a few hours. It's not that bad.
Is this an iPhone
terrible.
7?
You need to plug it in after this show.
Yes,
3
something
hours
like
after
that.
the show.
Are you on your
Do you not get
phone?
charge anxiety on the phone all the time, Bramo? All right, latest story. DirecTV filing a complaint with the FCC against Disney, accusing Disney of failing to negotiate in good faith and engaging in anti-competitive behaviour. This coming after DirecTV customers lost access to both ABC and ESPN more than a week ago. And we still haven't addressed this issue. Some people thought it might only last a few days, and here we are.
This is going to be really key to me also. How do some of the antitrust regulators deal with the fact that right now the balance of power has shifted to a lot of these content providers away from cable? How committed are people to preserving old cable the way it used to be versus the new media? And are they going to get more materially involved? What's the actual case that they have on an antitrust level?
I want to know if they really think that Disney is negotiating in bad faith, or if the issue is actually about trying to heat up the rhetoric ahead of Monday Night Football, ahead of a tomorrow really important debate. Do they want their 11 million customers, many of them in San Francisco and New York, be able to see the 49ers and the Jets?
Perfect timing. Perfect timing to really heating up this debate. Let's turn to this story, the latest out of China. China's core inflation cooling to the weakest level in more than 3 years. Core CPI rising just 0.3% in August from a year earlier, boosting the case for stronger stimulus efforts as weak demand puts its annual growth target under pressure. Just go through where we are right now in financial markets. Chinese stocks near 5-year lows. That's the equity market. The commodity market, iron ore, continuing to sell off. The picture for Chinese growth just is not great at the moment. And we spent a lot of time talking about the death, the end of US exceptionalism, not enough talking about what isn't happening abroad. You're not seeing a pickup in Europe, Germany. You're not seeing a pickup in China.
The U.S. is exceptional just simply because it's not as bad as the rest of them, right? I mean, that's sort of part of the story here. The fact that you saw iron ore sink below $90 a ton highlights how maybe China comes in with fiscal stimulus, but it's not going to be boosting their infrastructure in the same kind of way. It's going to be directed in another direction. When I talk to corporate executives in the United States, a lot of them still continue to talk about expansion in China. How long can that continue? At what point does this hinge on Donald Trump being a tariff man or not, and what those tariffs look like? When you ask them, what is your biggest concern for the next year? Without a doubt, every single one of them says the strength of the consumer, both in the U.S. and in China, and what tariffs look like, and how much that really fundamentally changes their strategies is significant.
And the nationalistic undertones picking up with the Chinese consumer over the last few years as well. That one is certainly relevant when it comes to Apple and that launch in the next 12 hours or so. Investors awaiting US CPI on Wednesday after a weaker than expected payrolls report on Friday added fuel to the debate over the size of the Fed's first rate cut. Steve Englander of Standard Chartered writing the following: CPI this week won't come in soft enough to put a 50 basis point rate cut back on the agenda. Once the Fed commentary is digested and the openness to aggressive easing on further evidence of softening is reflected upon, we think risk appetite may well come back. Steve joins us now for more. Steve, welcome back to the programme, sir. Let's talk about the quiet period for the Federal Reserve and the last comment we got coming into it from the likes of Governor Waller. What was your big takeaway from that address following payrolls on Friday?
One thing that really struck me was his comment that he thought that neutral employment growth was 80 to 100,000, pretty much what we had thought in 2018, 2019. No matter how you construe any sort of moving average, we're not there yet. So he seemed to be far away from concern that you had to do anything extraordinary. He didn't close the door on it. But overall, he seemed to be like a 25 basis point person. And, you can debate what is driving the Fed. Is it the weakness in the employment and the labor market, which, since the previous labor market release, that's been the big driver of all the rates move? Or is it the fact that inflation has come much closer to target? He seemed to be much more on, right now it's inflation coming closer to target, so we can afford to gradually take rates down. But we will pay attention to the labor market in case it really turns over, but it hasn't yet. So I thought he put quite a damper, at least in terms of saying, have the hawks shifted towards the dovish stance? The answer is, probably not.
So, Steve, just to build on that, it sounds like what we hear from Governor Waller then is that he believes the labour market is just normalising. It's cooler, but it's not cool. It's weakened somewhat, but it's not weak. So, Steve, the question I would ask of you is, how do they communicate the next move of the Federal Reserve, given they've all but communicated it will be a rate cut? Do they see that as a mid-cycle adjustment? Do they see that as the beginning of normalization and going back to, I would say, neutral? What I don't hear is let's get accommodative and let's get accommodative quick. How do you think they communicate that on September 18th?
Well, I think what they're going to emphasize is that they're at the beginning of a rate cycle, and they've all said rate cutting cycle. They've all said that. I think they're going to convey that there's going to be more than one, and there's probably going to be a sequence of them in the near term. What they're not going to do is commit to, whether it's 25, 50, or more, and kind of imply that I think the baseline is 25. I also suspect that quite possibly the sort of in the projections, by the time you get to the end of next year, they'll sort of be where the market is, mid threes maybe, but not, something that's 2.5 or 2 or something that's really dramatic. And that will show up in their other projections as well, that they're, we're kind of in we're cutting more than in 1996, but the economy is kind of like in 1996. It's doing okay, but because inflation's at target, we can afford to move, to get rates back to neutral.
A lot of what the market's trying to figure out is where the Fed is, as John was pointing out, relative to where markets are pricing. And we were talking about U.S. exceptionalism. And maybe it's not dead, not because the U.S. is doing so wonderfully, but just because the rest of the world isn't really doing so wonderfully. Steve, how much do you think that it is a liability to ignore the ECB later this week, to ignore some of the weakness that we saw in China, some of the weakness that we're seeing in Germany, as a reason to maybe fly in the face of some of the weakness we've seen in the dollar over the past week?
I think the Fed is struggling with the data. We've argued that immigration and undocumented immigration increases the labor supply. And so that distorts, to some degree, relative to past comparisons, it distorts, how do you interpret 120,000 jobs or 150,000 jobs versus 5 years ago? It also affects GDP. The numbers are coming in, GDP now is like mid twos. Is that that's pretty good if you think that there hasn't been a shift in supply, or does that translate into 1.5 like 5 years ago? And so I think that they're not yet ready to reject the numbers, but they're trying to sort out exactly what these numbers mean, and it tells them to go gradually. And so I think it makes it harder for them. There's not a good playbook for when the shocks come from the supply side, and 99% of what they write is focused on the demand side.
Yeah. Let's just do scenario analysis and say that the data doesn't change materially between now and September 18th. If the Fed cuts by 25 basis points or by 50 basis points, what's the difference in the market reaction from your view?
The market was trading last week as if it desperately wanted to get a 50, that the 50 would sort of calm it down. And it was almost as if it had the shakes that it needed that 50. I think at the end of the day, 25 versus 50 doesn't matter much. It also, it's quite possible we have a 50 penciled in for Q1 of next year. If they did it December, or if they did it January as we have, I think the market will be just fine with it. But I think that ultimately what the market needs to see is that the Fed's on a cutting path and that they're cutting towards the 3 handle, and the market will be okay with it. But I think in the short term, you just look at what's priced in. It's still close to, I think 110 basis points over the next 3 meetings. That's not, there's an adjustment there if they're going to be doing 25s, or if the first 2 cuts are going to be 25s, rather than, doing the 50 that the market wants. And I think that's a nut that the market really needs to crack there to be able to deal with. And obviously today the equity market's doing okay, but we're seeing bonds under pressure, and we're seeing the rest of the world under pressure.
Well, Steve, let's talk about dollar yen and just finish there. I remember when a 1% move on dollar yen used to mean something. I'm not sure if it means anything anymore. We've got a 1% move this morning. Dollar yen's back to just short of 144 at 143.71. What is this FX regime, Steve? How would you describe where we are?
I think the market wavers on the yen. That the we think the BOJ could be more aggressive than what the market's pricing in. We think that that they're determined to raise rates. One of the puzzles is why the market sort of thinks that doing another 10 or 20 basis points over 6 months is going to be enough to get the BOJ to wherever they want to go. But I think in the short term, we saw positioning move like long yen and short dollars. And, the Friday sort of discussion was so abrupt, I think, in terms of shaking the market conviction that, some of those positions are getting shut down and pushed closer to neutral. But we still see 130 at the end of next year. We think that this is temporary, and that as the Fed cuts and as the market sees convergence really manifest itself, we will see dollar weakness. They just have to get over the fact that the Fed may not deliver in the short term what the market really wanted.
A few years ago, I might have said, wow, 130, that's a big move, Steve. And maybe we'll see that next week based on some of the price action. Steve, thank you, sir. Steve Englander there of Standard Chartered. Appreciate it. Dollar yen with a 1% move, 143.74, a weaker Japanese yen this morning. Let's give you an update on stories elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. A gunman has killed 3 Israelis at a terminal on Jordan's border with the West Bank. It's the first such incident since the war in Gaza began. Israel's army says the gunman accessed a bridge crossing from the Jordanian side in a truck and fired shots before he was killed. The victims were identified as forklift operators. Israel closed the crossing while checking the truck for explosives. Boeing and its largest union say that they've reached a deal to potentially avoid a strike at the troubled U.S. aircraft maker. The offer includes a 25% wage increase over 4 years and a commitment to build Boeing's next plane in Seattle. That breakthrough came after a marathon bargaining session, but it is too soon to know if workers will go along with that deal. Elon Musk is doubling down on Donald Trump. Musk's pro-Trump America PAC launched ads targeting swing state voters across digital platforms. One YouTube ad says, if you sit this election out, Kamala and the crazies will win. The PAC has spent around $1.4 million on Facebook and Instagram ads alone since May. That's according to data from Meta. It also showed that it was one of the top 10 U.S. political advertisers for Facebook in the week ending September 3rd. That's your brief, John.
Hey, Danny, thank you. Danny will be back in about 30 minutes' time. Up next on the programme, the Fed's next move.
I do think that they need to gather in the room and think hard about, do we want to go towards 25 or 50? 25 is the right number, given that literally everything in this report was better than in July.
Torsten's Lock of Apollo, absolutely brilliant to close things out last week going into the weekend. Check out that interview on Bloomberg.com and on the Bloomberg terminal. Torsten's Lock of Apollo thinks this economy is still better than okay. From New York, this is Bloomberg. Bouncing back from Friday's losses, equities just about positive on the S&P 500. A nice bounce, decent, firmer by 0.7%. Yields are higher too, up 4 basis points on a 10-year, 374.75. And talking about an unwind, a reversal of some of Friday's moves. See the same thing on crude. Crude bouncing back from an ugly week of losses last week. WTI up 0.8% to 68.21. Under surveillance this morning, the Fed's next move.
I do think that they need to gather in the room and think hard about, do we want to go towards 25 or 50? 25 is the right number, given that literally everything in this report was better than in July. If we really had restrictive monetary policy, why have we for 2.5 years and counting still been getting very good economic data, including GDP in the second quarter at 3%?
Here's the latest. Traders gearing up for a busy week of economic data, with attention turning to Wednesday's CPI print ahead of the Fed's decision on September 18th. Nela Richardson of ADP writing, CPI measure of inflation from the Bureau of Labour Statistics is the most important indicator of the week. It might influence the size of any Fed rate cut, be it 25 or 50. Bloomberg's contributor, Nela Richardson, joins us now for more. Nela, good morning to you.
Good morning.
It's good to see you. Let's start with the labour market on Friday, then we can shift towards CPI. A word that I think you own. Dynamism. You talked about this. Are we losing dynamism in this labour market?
In a word, yes. Hiring rates are lower now than they were in 2019. And remember that dynamism has been the hallmark of the U.S. labor market. The fact that people are willing to pick up and move to better opportunities. Literally move, they don't actually have to do anymore because of so much remote work. You should see a dynamic churn in the labor market that's healthy. You're not seeing that as much. It's a slower hiring rate. People are staying longer on the job. That could be that there are not better opportunities. It could be that, firms are keeping and motivating people on the job. I think it's more the former. When I talk to companies around the country, they're a little surprised that turnover is so low. And so there's been some tweaks in how they hire to adjust for the fact that people are staying on the job longer.
Just to build on something that you said at the end there, is there some indication you think that we can maintain the current state of things? Because there is a fear, particularly in financial markets, that maybe we go off the deep end sometime soon. How do you think about that?
There's been a lot of talk about whether this is a soft landing or a hard landing, and my argument is it matters where we're landing. And I think we are landing in a different set of labor market conditions that is different from where we left. Dynamism is slower, manufacturing will be a persistent drag on employment, and pay growth is elevated. It's stabilizing at an elevated rate. These are the conditions on the ground. Now, I still think that those conditions are good enough to propel consumer spending and economic growth, but they are different on-the-ground conditions than where we left.
What's the reference point? Is it 2019?
It would be 2019, in my view, and those months leading into the pandemic. There you saw a manufacturing sector that was shedding jobs, but you saw higher hiring rates. Unemployment was a bit lower. There was more churn in the labor market. It was a little healthier than what we're seeing now.
You talk about soft or hard, a labor market landing is close at hand, and you talk about the destination has changed. And that's why you talk about it's about where we are landing. Right. My question is, what kind of economy is it that you're describing? It sounds to me more stagnant, more not necessarily this inflationary kind of fast growth environment that a lot of people have just been pricing in.
No, we're seeing an elevated wage growth, but not wage growth that's going to trigger another bout of inflation. Wages are actually stabilizing. And you see that across the board, whether you're looking at new hires or people who've been in the job for a very long time or people who've recently switched jobs. The wages are stabilizing, and that's good news for the inflation story. It's not great news for the dynamism story that really propels people to churn and companies to seek out the best talent. We're not seeing that kind of competition in the labor market like we did in 2022, which was extreme, I grant you, but we're not going back there.
You've looked a lot about manufacturing and how basically they've gone negative this year. Wasn't that fiscal spending supposed to help this sector?
But those dollars haven't been met yet. Right? So those dollars have not really changed the game in terms of manufacturing, and demand is still sluggish. So you're looking at new orders those numbers that came out recently were lower than expected and lower than where we've been. And then they didn't shine a light on a rebounding manufacturing sector. We're still very far. This economy has tilted into services. So in my view, you have a service sector that is normalizing in terms of a labor market and a manufacturing sector that is weakening. You add those two together and you have a softer labor market.
But if you're saying the money hasn't reached it yet, does that mean potentially you could see manufacturing jobs pick up next year?
It depends. The thing about this type of labor market is it does rely on skilled workers, and vocational talent has been hard to come by. It depends on what kind of skills are needed in those manufacturing jobs, and it depends on whether we as an economy are producing the right skill set for the right jobs that could actually boost that sector, and I think that's an open question. And manufacturing is also dependent on the rest of the world and how the rest of the world is doing, and that is also an open question.
Got 30 seconds to squeeze this in.
Yeah.
Is official data losing credibility?
No, we need our data, especially when we have a Fed that is data dependent. But it is growing. So you have private sector data like ADP showing private sector job gains have slowed. Using that data in collaboration with official data sources is the right path forward.
I was just being kind and setting the stage for an ADP victory lap. just then.
I know.
Weren't you?
That was a good job. Nela was very diplomatic, though.
Trying to do that for Nela there.
Was...
Nela, thank you. It's good to see you.
Thank
you very much. Nela Richardson, a Bloomberg TV contributor, and of course joining us from ADP. Coming up on this programme, Yardeni of Yardeni Research, Terry Haines of Pangaea Policy, Bloomberg's Mandeep Singh, and Sonal Desai of Franklin Templeton, with equity futures positive 0.7%, still near session highs from New York. The second hour of Bloomberg Surveillance, up next.
We're still in that soft landing cap. There isn't any indication to us that the economy is decelerating at an accelerated pace.
There's a lot of reasons to think that inflation could be stickier, and the Fed is really focused on that.
We really don't see an environment where the economy is going to fall off the cliff.
In the aggregate, the growth data is just not showing signs of a slowdown.
We're still pricing in very much a soft landing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So this time last week, we opened up the programme, we sat here and said payrolls on Friday will determine the size of the next rate cut of the Federal Reserve on September 18th. The difference between 25 and 50 is whatever payrolls might be. Payrolls dropped, settled absolutely nothing. And here we are waiting for CPI with a belief on the margin that maybe CPI could settle the difference between 25 and 50. Equity futures look like this on the S&P 500. It's a bounce back up by 0.75% following the worst week of the year so far. On the Nasdaq up by 0.8, on a Russell up by 0.2. CPI coming later this week, PPI as well, but there's plenty of events in between. An Apple iPhone launch a little bit later on today, a big debate between Harris and Trump coming up tomorrow, and UMich consumer sentiment, Lisa, on Friday.
And UMich consumer sentiment might actually turn the tide. The reason why, and I want to go back to where you started, this idea that we were hopeful that maybe this jobs report would give us some clarity, and it gave us none. We keep waiting for enough data that Fed officials tell us will determine the difference between a larger or a just sort of measured rate cut in the September 18th meeting. The reality is we're looking for some sort of exit strategy from this confusion, this morass of conflicting data, and we're not getting it. And what does that mean is something that the markets are really struggling with.
We've got a live meeting coming up in a few weeks, and maybe we even get some dissent on that live meeting on the FOMC. Perhaps that dissent comes September 18th.
Oh, potentially we get that dissent, Jonathan. I was looking back last night about that memo put out by Raphael Bostic on September 4th, not too long ago. History shouts to us that loosening monetary policy preemptively is a dangerous gambit. There is still some concern, and I'm sorry, Governor Christopher Waller didn't really give us that definitive answer whether or not it's 25 or 50. Sure, the time has come. But what exactly are they going to do? That remains a question.
Jobless claims on Thursday as well. Last big read on the labour market going into that Fed meeting next week.
You know, I almost forgot about the ECB meeting on Thursday, and I think a lot of people did. I mean, really, like when I was thinking about the particular events this week, I was thinking, okay, what else? And you pointed out, oh yeah, the ECB. And I actually think it might be quite interesting, considering the fact that everyone's kind of written off the ECB as simply following in the footsteps of the Federal Reserve. They have it a lot worse. And let's just put it very starkly. They're facing some real economic weakness that cannot be sugarcoated the way that it can in the United States. That might be one of the more interesting moments where we see what is the response function to both inflationary pressures that haven't fully died, but at the same time, real weakness that is not just the US's, but globally.
I'm really pleased you brought this up. We've talked about this a million times. In Germany, the model is broken, and there's no evidence, any real sign that they've come up with a new one that might be successful anytime soon. Europe, just a derivative of what's taking place in China. China's facing a deflationary spiral. The equity market's near a 5-year low. The commodity market's started to get pulled under it as well. What you're seeing in iron ore is hardly a signal that things are robust and great over in China. So if you believe that the US exceptionalism is fading, I think we've got to ask a question. Who's replacing it? Because Europe and China look like they're both in a tough place.
Which is the reason why it's so difficult to understand the moves in the markets. Last week, people were saying that the dollar was pricing in a 50 basis point rate cut by the Federal Reserve. People were saying that bond markets were pricing in a recession in the United States. And Priya Misra came on this show from JP Morgan and said, absolutely not. What it highlights is people expecting the Fed to adjust to the normal that we see currently in terms of inflation. This has to do with the international picture, too. Basically, can you see that kind of dollar weakness, given the fact that the U.S. economy economy is still the strongest in the world and really continues to outperform some of the laggards, particularly in China and Europe.
Joe Quinlan, though, had an interesting take on this. He's like, is this really exceptionalism, or is it just the fact that the U.S. is the one that's out in front because everyone else is doing so poorly, to your point?
If you are just joining us, welcome to the programme. Let's get to the scores. Equity futures right now positive by 0.7%. Talked a little bit about what's happening with crude last week. Terrible week. Down 8% on WTI, bouncing back by 0.9% on crude this morning. In the bond market, yields higher across the curve, up by, let's call it, 4 basis points on a 10-year, 374.56 on a 2-year, 369 up 4 basis points, and the difference between the two, positive. The 2-year, 10-year yield, that slope is positive, Lisa, and closed there for the first time in a couple of years on Friday.
Do you buy that this is a negative signal or a positive signal?
I buy that it's been a negative signal over the last few cycles. Once you get that bull steepener kicking in and start to expect a deep, aggressive cutting cycle from the Federal Reserve, it usually means not great things are happening in the economy.
We've never seen a deep rate cutting cycle from the Federal Reserve without some kind of recession, and everyone's saying this time is different. And that's what I find fascinating. How much can you lean into that because of the post-pandemic realities that have been distortive to a lot of the economic data?
How different are things this time? In the next 60 minutes, the lineup looks like this. Yardeni of Yardeni Research, with stocks looking to rebound ahead of CPI data. Terry Haines of Pangaea Policy on expectations going into the Trump-Harris debate. And Sonal Desai of Franklin Templeton on why current market pricing of rate cuts is too aggressive. We begin with our top story. Stocks coming off their worst week since March 2023 following Friday's payrolls report. Yardeni of Yardeni Research saying what's happening now is no more than another growth scare that will pass. Once again, we expect that the economy will surprise to the upside. Our assessment of Friday's employment report is that it wasn't as bad as widely believed. Ed joins us now for more. So, Ed, let's go through that quote and just deconstruct things a little bit. One, why wasn't it as bad as widely believed? And two, where do you get the confidence that growth will continue to pick up and surprise to the upside in months to come?
Sure. Well, it seems as though everybody ignored the fact that average weekly hours actually increased by 0.3%. So we had that, and then payrolls were up only 0.1, but put it together and you got aggregate weekly hours for the economy at an all-time record high, increasing 0.4%, which is a very solid increase. And it suggests to me that real GDP is still growing somewhere between 2.5% and 3%, because when you look at aggregate weekly hours on a year-over-year basis, they're up 1.1%. So the question is, how do I get real GDP up to the 2.5% to 3% when aggregate hours are increasing by 1.1%? And again, the variable that everybody's ignoring is productivity. Productivity has been really very strong since last year, and I think we're in a productivity growth boom that will boost GDP.
So let's compare that to what's happened in the market, Ed. As you know, a lot of people have got a different view. Equities have sold off, bonds have rallied hard, yields have dropped a lot. Of those two asset classes, which one do you think's too far extended? Which one would you be leaning the other way?
Well, I think the bond yield is getting pretty close to a bottom here. If you look at the peak yield curve spread, so I'm looking ahead already beyond the disinversion that we've just seen to how much of an ascent are we going to get in this yield curve. It could be at least 100 to 150 basis points. And so the bond market's discounting lots of rate cuts, and I think that reflects a misleading view that the economy is not resilient after all, and that we're finally going to have a recession. And that's just not my opinion. It looks to me as though the economy is going to be particularly strong this month when we look at August data for personal income and personal consumption. That looks like it's going to be a very strong number, as does industrial production, which we're likely to see some offset to the auto drop that we saw in July. The auto production dropped significantly in July, which probably just was a seasonal aberration. So you put it all together, and I think we're going to get some pretty good economic indicators here. I think the stock market has had another carry trade hissy fit, as we saw in early August. And that's because the Bank of Japan has announced that they are still on course to raise interest rates. And so the weak employment numbers, perversely, you would think that the weak employment numbers would make the stock market go up. Why? Because the Fed's going to do 50 instead of 25. And that kind of thought really unwound the carry trade once again. And I think that's why the stock market was so weak last week.
And let's pick up on that point. There's a lot to unpack there with the yen carry trade. Mike Wilson over at Morgan Stanley talking about how there's still a lot more to go in terms of that trade unwinding. Do you agree?
Well, I think that view is too pessimistic. I think the carry traders got the message in August, got it again on Friday. I think a lot of it has, in fact, been unwound. But I do agree that if the Fed goes for 50 at September 18th, there'll be more carry trade to unwind. So you would think with a bigger than expected drop, or instead of 25, 50, I guess 50 is increasingly expected. If that were to happen, I think you'd get probably another round of carry trade in a difficult market, but I think they're going to go for 25.
Well, hold on a second. This is actually fascinating, especially because you were talking just a couple months ago about how if the Fed were to cut rates, that would turbocharge equity markets to an unhealthy degree and could create another bubble. And yet, from the technical setup right now, actually, an outsized rate cut by the Federal Reserve would actually depress stock valuations. So can you pair these two ideas?
Oh, yeah. Time is money. What's changed what's changed my view is I didn't see the carry trade unwind coming. However, if you look at a chart of the Nasdaq versus the yen, it's pretty clear that there's been a very strong inverse relationship. A strong yen caused by this differential in monetary policies is bad for the Nasdaq because it unwinds the carry trade. So that's what's really changed in my thinking, but the carry trade will unwind, and we're going to be left with somewhat lower interest rates, and that could very well lead to a very strong year-end rally. So I think lower interest rates are still bullish for the stock market, and could very well give us something that, believe it or not, looks like a melt-up by year-end.
Ed, you also talk about after November 5th. That you're going to see the S&P 500 resume its climb to new highs, but remain choppy through November 5th. Are you seeing new highs regardless of who is elected president?
Well, the underlying assumption in my forecast on that is that the big winner on November 5th will be gridlock. If we get a Democratic sweep or a Republican sweep, I'm going to have to change my mind pretty quickly, and I think the market's not going to welcome that at all, because I think both candidates basically have one thing in common, and that is they don't really care about the deficit. And one way or the other, whether it's a Democratic sweep or a Republican sweep, that would imply a much bigger deficit, which I think then could really unravel this bond rally pretty quickly.
Ed, we've got to pick up on that. Are you saying the bond vigilantes make a trip over from the UK and France and have a little visit to the US?
They could very well. They actually, last time we saw them was last summer, August, September, October, when we went from 4.25% to 5% in a heartbeat. And that was because of concerns about all the supply of treasuries. But Janet Yellen came up with a clever trick, which is to finance more in the bill market, less in the bond market. But you can only play that game, I think, once. I don't think it'll work again if, in fact, we get a sweep of one party or the other.
Ed, thank you, sir. Ed Yardeni of Yardeni Research on the bond market. Drum roll, supply.
Okay, $58 billion of 3-year notes coming tomorrow. We've got $39 billion of 10-year notes on Wednesday and $22 billion of 30-year notes being sold on Thursday. 1 p.m., all the auctions take place. I'm particularly interested, as I usually am, in the longer end, just in terms of how many people come out and at what point this sort of balancing out of the yield curve gets challenged, not by the front end, not by the rate cutting assumptions, but by some of the deficit worries that we keep hearing percolate out, even though they don't seem to come to the fore when these auctions come to the table.
That's Treasury supply. We've had a ton of credit supply over the last week as well. Last week, massive week for corporate debt issuance. Let's get you up to speed on the latest elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Former ECB President Mario Draghi says the EU can't be competitive unless it commits to much larger spending. The ECB had tasked Draghi with building this report, and he concluded that the region needs to spend as much as 800 billion euros extra a year, a level not seen in more than 50 years, and issue regular common bonds. He wrote that unless Europe becomes more productive, it won't become a leader in technology, a beacon of climate responsibility, nor an independent player on the world stage. Kamala Harris and Donald Trump are getting ready for their first, and for now, only debate tomorrow night in Philadelphia. And the race is airtight with just 57 days until the election. The latest New York Times Siena College poll has Trump in the lead over Harris among registered voters by just 1 percentage point, 48% to 47%. Following the debate, Harris plans to travel to key battleground states, including North Carolina, on Thursday. Big Lots has filed for bankruptcy protection. It's planning to sell its ongoing assets and ongoing business in a court-supervised process. The discount retailer agreed to sell the business to PE investor Nexus Capital unless a higher bidder emerges. Big Lots has around 1,400 stores and employs over 30,000 people and has suffered from declining sales for years now. That's your Bloomberg Brief. John.
Brutal. Danny, more from Danny in about 30 minutes. Thank you. Up next on the program, momentum shifting down the ballot.
Democrats have had some momentum in the last few weeks to catch up, but now the rubber's hitting the road. And I think we've got adequate funding in the House to hold the House, pick up seats, and I feel optimistic about the Senate as well.
We'll pick up on that conversation in just a moment. Live from New York City this morning. Good morning. Stocks positive this Monday morning, up 0.75% on the S&P 500. In the bond market, Treasuries down, yields up 4 basis points on a 10-year, 3.7475. Under surveillance this morning, momentum shifting down the ballot.
Both our challengers and our incumbents had excellent hard money fundraising up until the summer. So they were leading their Democratic opponents across the board through the summer fundraising. Democrats have had some momentum in the last few weeks to catch up, but now the rubber's hitting the road. And I think we've got adequate funding in the House to hold the House, pick up seats, and I feel optimistic about the Senate as well.
So here's the latest. Donald Trump and Kamala Harris set to face off in their one and only scheduled debate tomorrow evening. The latest polling showing Trump regaining a 1-point edge over Harris nationally. Terry Haines of Pangaea Policy writing, the likeliest result of Tuesday night's debate is Harris will be perceived to win by demonstrating fitness to lead. The Harris wins result would strengthen our view that Harris is 60% likely to win in November. Terry joins us now for more. So Terry, let's pick up on that comment, sir. Where does that advantage come from?
The Harris advantage or the Trump advantage, John?
The Harris advantage that you say she has going into tomorrow and will likely retain coming out the other side.
Oh, I think it's two things. One, you have both campaigns engaging in what the Kennedys used to call underdoggery right now. The idea that they're the underdogs, they'll come from behind, making points on those regards. I think that Harris needs to meet or exceed expectations, and there's a lot of uncertainty about who she is, what she stands for, what she's like, frankly. And that can only be answered on a large national stage. If she does reasonably well on that stage, I think people come away with the idea that she's a plausible president, and that acts, I think, as a sort of magnet helping things in her direction by and large. And of course, there's also a lot of press kind of rooting for her, too.
Terry, in the New York Times poll over the weekend, it said more than 60% of likely voters said the next president should represent a major change from Biden, but only 25% that the vice president represented that change. 53% said Trump did. So if people are, in what this poll is showing, fed up with the Biden administration, why do you think she can still win?
Well, the Times in Siena ought to be asking people if the biggest change is the one that they might like, because there's not a lot of correlation between those two in the poll. Why do I think she can still win? Because firstly, they're neck and neck. Secondly, because I think her theory of the case on how to win is better than Trump's. What Harris has done is consolidated Democrats and is reaching out to independent and undecided voters using social issues and, frankly, Trump loathing. What Trump thinks, by comparison, is in a very swing state sort of strategy, is if I can get 100% of my own base out, which is not all the Republicans, it's his own base, what I can do is I can overwhelm Harris voters and Harris enthusiasm. I don't see that happening for a bunch of reasons, not least of which is that Trump's base isn't the whole party. The establishment party is now pushing against him, and he's not making a convincing case to undecideds, I think.
These individuals have never debated before. Trump, I believe this is his 7th presidential debate. What does she need to do to create a viral moment, kind of like she did with Mike Pence back in the VP debate, given the fact that the mics will be muted and she can't say something like, "Excuse me, I'm talking"?
Right. No, I think that's a very smart question. If I were her, I wouldn't go for viral moments. If I were her, I would be going for kind of prosecuting the case. What she will say is, not only will she be interested in kind of establishing her own bona fides, turning the page. Her great siren song right now is turning the page from the last decade, which not only includes Trump, but Biden, I should point out, as well as saying the words convicted felon as much as possible. And then, frankly, pointing out that the establishment of the Republican Party also isn't against Trump. So the cumulative impact of what she wants to do is establish herself as a safe pair of hands, as somebody that can be trusted, as somebody that will do as a president. But
Terry, the establishment Republicans have been against Trump for years now.
Yeah, that's true. But at the same time, it is only now going to start becoming apparent that, for example, you have the last 2 Republican vice presidents against Trump. You have Bush 43, the last Republican president before Trump, not making an endorsement. You've got half the Trump cabinet against him. That stuff starts to weigh on people, not least because the signal it sends to undecided voters, particularly those who trend Republican, is it's okay. We give you permission to not be for this guy.
You talk to a lot of clients who are trying to get clarity on policy, which is a fool's errand right now because a lot of the policy that we're hearing is sort of a vibe. And a lot of people say, especially in the industries that are relevant, that it's just talk, it's a rhetoric, it's a starting point. How do you sort of help your clients navigate rhetoric that a lot of people, we just heard French Hill, Congressman from Arkansas, talk about how the talking about it being a tariff man by Donald Trump was just a starting point for negotiations, not actual policy. How do you advise your clients?
Well, firstly, by agreeing with them on that. Secondly, I commend to everyone Congressman Hill's interview, an absolute top-tier member. And by the way, I thought he undermined the president's case pretty subtly, but effectively on a lot of those things. Thirdly, by telling them that it's not about the president, it's about the president plus Congress. And the base case today, regardless of whether Trump or Harris become president, is that you've got a split Republican Congress again. So what you're going to end up with is a lot more of the remixed status quo. And, I differ with Yardeni a little bit in the last segment, because regardless of whether or not there's a Republican or Democratic sweep or there's a mixed Congress, what you're going to end up with is still increases in fiscal debt and deficits. So that's not going to change.
That said, with tariffs, that's something that unilaterally can be done by a president. And it's the reason why people, in particular in business, are really focused on whether that's a starting point for negotiations with China or something actually real. How do you decipher?
I consider tariffs a bluff for a lot of reasons. One is that I'll agree with Congressman Hill that it's a guy having fun and talking. Secondly, the last thing Trump is going to want to do if he wants to increase economic growth and productivity is impose tariffs way before there's even a chance at a tax deal. Back in 2017, you'll recall that it took Congress a solid year, to come up with the 2017 tax law. If he's talking about imposing tariffs unilaterally from day one or close to day one, among other things, what he's going to end up with is a negative street reaction and a negative economic reaction for almost a solid year before those before that tax relief comes. And frankly, I doubt, unless it's a Republican sweep, which I give about 20% today, the chances for tax extension is zero. So because Democrats don't want it. So, I doubt Trump is going to tank the economy.
Terry, thank you, sir. Terry Haines there of Pangaea Policy. If you're an investor right now, the one thing that would make me really nervous is how big the gap might be between how they're campaigning and how they might govern.
I couldn't agree more. What are we going to get from either of them if everyone's saying that what they say is not really what they mean?
Big issue. Coming up on this program, Apple getting ready to unveil its newest iPhone, plus major changes to the watch and AirPods. Mandeep Singh of Bloomberg Intelligence up next. Equities on the S&P 500, a lift here of 0.8% on the Nasdaq 100. A rally, a pickup of 1 full percentage point after a big weekly loss last week on a 4-day slide on the S&P 500. The worst week of the year so far. In fact, the biggest weekly loss going back to the bank stress of March 2023. That's how bad last week was. In the bond market, yields were aggressively lower. Now they're a little bit higher across the curve. 2-year, 10-year, 30-year. Here's the shape of the curve right now. Up 5 basis points on a 2-year, up 4 on 10s. We're looking at 369 versus 375. And we have a yield curve that is slowly and then quickly normalizing.
I do wonder how much this was a growth scare last week. This is what people have been sort of talking about in a lot of these notes, or whether it was just a carry trade unwind, the way that Ed Yardeni was talking about. We didn't necessarily feel the violent fear in markets last week. Let's just be real clear. It sort of seemed like a light trading week, and people said September usually goes down. And oh, by the way, you're going to have Fed rate cuts, so let's buy bonds, let's sell stocks, and think about what the logistics are later.
The hope was certainly for something more decisive, but just to look at the so-called totality of the data, just last week, ISM services was okay. Jobless claims was okay. Unemployment came back down to 4.2%. It's why people like Torsten Slock of Apollo are making a case that things are okay.
I guess that the bigger picture question, and this is something that I thought that Priya Misra did a fantastic job talking about, how much is the Fed's move in response to true weakness, and how much is it normalizing at a time where inflation is no longer the preeminent concern? This is the reason why I think CPI could be more interesting on Wednesday than a lot of people gave it credence for, simply because if inflation is truly not a risk, what is the argument for the Fed to keep rates where they are, given the fact that regardless of the totality of data, the one message that you're getting is what Nela Richardson was saying, that the dynamism has gone down and you have seen a real slowdown in the labor market.
Neil Dutta, Renmac, 8:30 Eastern Time, so 60 minutes from now. Don't miss this conversation. He put out a big piece on LinkedIn over the weekend, and this was the quote that jumped out for us here at Bloomberg. I'm seeing a lot of wildly optimistic takes out there. Almost feels like people are allowing a political narrative to cloud their analysis of the data. The fact is conditions are getting worse, not better. Goes on to say, there will be a time to be bullish. I'm not sure now is the time. The Fed should go 50 when they can, not when they must.
So putting the political aspect aside, Neil, welcome. Because at a certain point, this is what a lot of people are seeing, is that you are seeing deterioration in the labor market that you can't sugarcoat. The question is, and I think Nela put this brilliantly, this idea of where's the end point? We're talking about some sort of landing, correct, but where? And that's, I think, the difference that people are trying to parse through with how many rate cuts they're pricing in. Are you talking about a real recession? Are you just talking about a bout of weakness? Is this back to 2019? That's what needs to get determined.
Speaking of weakness, the dollar has been weaker. It's stronger this morning against the bulk of G10, with the exception of the Canadian currency. The euro's down to 110.39. Dollar yen, with a sizable move, it's close to 144, 143.75. I joked about this with Steve Englander of Standard Chartered early this morning. 1% moves on dollar yen used to mean something. It would mean something had happened. And now we're just looking at this associated with the risk bounce that we're seeing elsewhere in equities.
Yeah, I'm so glad you brought that up, because we've seen volatility that has been unprecedented, not just in currency moves, but also in Fed funds futures last week. Unprecedented moves in terms of probability. When it comes to the yen, this is a twofold story. On one hand, you have this question of just how much the Fed can actually cut rates. And then in Japan, you did see GDP revised lower. This sort of flies in the face of their ability to raise rates. Some people might say. Everybody else quickly came back and said they still are going to raise rates later this fall. Nonetheless, it sort of challenges this idea that Japan can completely diverge and continue on its tightening cycle.
Dollar yen, 143.73. Under surveillance this morning, some top stories for you. Treasury Secretary Janet Yellen saying the U.S. economy has reached a soft landing even as job growth weakens. Speaking to Bloomberg's David Gura on Saturday, Yellen highlighting falling inflation and rising wages, saying she sees no red lights flashing for the U.S. financial system. Now, is this Janet Yellen the economist or Janet Yellen the politician?
Well, she is a labor market economist, right? And she says she does want to monitor any downside risk in the labor economy. But of course, this is highly political going into the November election. And many on the other side would just take criticism with the fact that she's saying she's not seeing any red lights because she's also the individual that said inflation was transitory.
You know, this argument about some of the commentary about a benign outcome for the economy being political, we heard that in Neil Dutta's commentary. Sure. We've heard it from others as well, talking about Janet Yellen. And even we've heard about this with Claudia Sahm, and maybe that she's not saying that her rule was triggered because of that. And I will just say that when you look at all of the commentary, you start to analyze it piece by piece. I cannot think of one person who's saying that the economy is falling into recession. Deep recession right now. Can you think of one person other than Andrew Hollenhorst who says that the risk of recession is increasing? Very few people are saying that. It's a question of where we land. Now, Janet Yellen, yes, 100%. She's completely political in every which way. No doubt about that. But it is complicating the totality of data, if you want to go there, to sort of talk about the political angle. It just complicates what you're seeing across the board, which is everyone's saying things are slowing down, period, full stop.
I remember asking someone about what it would take to be a good central banker, and they gave me one word: lie. And I often think about central bankers, and I think they're well aware that they have the ability to influence the events they anticipate. If they actually came out and started to talk about the labour market and the downside risks that they perceive at the moment, I think you'd be a lot more worried about the future. So they sort of have to pull back, and I think Janet Yellen's been schooled in that in the Federal Reserve, hasn't she, over many decades of that institution.
If the Federal Reserve came out and said they were worried about downside risks.
Well, they say that anyway, but if they said that we think we're going into recession, you'd be in one tomorrow.
Well, do you think so?
Oh, immediately. Think about how people would change their behaviour.
You think so, even if they cut by 100 basis points?
What would happen to markets tomorrow? They come out and say recession tomorrow.
Well, if they said recession tomorrow, and then if that's the reason why we're going to cut rates to 2%.
People out there that think if they go 50, they know something we don't know.
I don't know. This is an interesting discussion because I've heard lots of people come out on both sides of the answer. Because what advantage does the Federal Reserve have to market participants right now? Very little. That's pretty much what everybody in the market says. And even Yardeni, who sees a carry trade unwinding if the Fed were to cut disproportionately, sees that as a buying opportunity. How many investors sort of start to see that carnage as a buying opportunity?
They're in the business of managing financial conditions. That's what they're in the business of doing. And they know their words carry a lot of weight. They have to be very careful about what they say. And I think you've got a clinic of that with Janet Yellen over the weekend, with a big dose of politics, of course.
Do you think that she does see more weakness and she's just saying?
What I think doesn't matter. Once you get into the business of trying to work out what people actually think, I just think that language is consistent with what you hear at the Federal Reserve.
I would agree with that.
Consistent with what you hear across every single Fed official right now at the FOMC, regardless of whether they think we should go 50 or 25.
I would agree. There is a very sort of whitewashed kind of rhetoric that you're hearing coming out of the Federal Reserve.
Big time, the real meat on Wall Street. Let's get to Morgan Stanley cutting its oil price forecast for the second time in a number of weeks. Amid mounting global demand challenges, the bank now seeing Brent averaging $75 a barrel for the fourth quarter, $71.60 on Brent, $68.25 on WTI. Last week, a difficult one.
OPEC Plus is going to have to do more than just decide to not put more barrels into the market. They're probably going to have to start thinking about cutting, especially in 2 months' time, as you hear traders come out and say we are oversupplied in 2025 and 2026. This just feels like kicking the can down the road. And how much do they want to maintain a floor in these prices, especially when they're up against the behemoth of the United States?
Sort of chasing those forecasts lower over the last few weeks. Lots going on this week, including this: Apple gearing up for its most important event of the year, where it will unveil its next generation iPhone, as well as major updates to its Apple Watch and AirPods. The Glow Time event kicking off at the company's Cupertino, California headquarters at 1 p.m. Eastern Time. Joining us now to break this one down is Bloomberg's Mandeep Singh. Mandeep, good morning to you, sir.
Morning.
How excited are you? How excited should we be about this event?
Actually, this is one of the biggest events in the last 2-3 years, simply because when you look at generative AI as a theme and how Apple is perceived as being missed out, I think this is where it all comes together for them, or it doesn't. And look, they don't have their own large language models, but what they have unveiled is Apple Intelligence. And you want to see how is it going to drive the refresh rates. I mean, at the end of the day, whether it's AirPods, watches, smartphones, you want to see them do things with their own apps. So their email app, calendar app, there is so much room to deploy AI on top of their own apps. Forget about the third-party apps. And that's what you want to see at the event.
Is it a big event just for Apple or for the whole AI ecosystem, the whole trade?
I would say the latter, the whole ecosystem, simply because we know the market is undersupplied when it comes to NVIDIA GPUs. AI inferencing is how the large language models get used. Right now, everything is being done on NVIDIA GPUs. If Apple unveils a phone that can do AI inferencing on the phone, that's a big deal. Suddenly, your inferencing costs go down. In fact, I would argue the NVIDIA undersupply situation also gets resolved to an extent because you can run AI on your phone, and it's free, by the way. You don't have to pay up as much for your copilots or your chatbots because you're doing it on the phone. So it's a very big deal for Apple if they can showcase that.
I'm glad you say it's free, because this does not come cheap for Apple. And we've seen how much NVIDIA has been able to increase their margins by how much they're charging and how much OpenAI is being valued at based on all of the potential investment. Can Apple afford to keep the prices pretty much level?
Absolutely. I mean, look at it this way. You're paying upfront for the phone. So if it's a Pro Max phone, you're paying, $1,000 or $1,200. But then you can use it for 5 years. You can use it the way you want. It's all free, as opposed to using a Copilot subscription or a ChatGPT subscription.
I guess that my point is that a lot of people are looking for Apple to increase pricing for that iPhone just simply because their margins are getting compressed. And they're turning into more of a utility than this high margin, huge cash flow behemoth that it was celebrated for. So at what point does it have to succumb to the margin pressure by increasing prices at a time that there's a real question about consumer demand and ability to pay?
I mean, Apple has got different tiers, and that's what they've done over the years. Is there's a Pro Max, there's a Pro, then there is a 16. So they will offer you different variants. The basic functionality is they've got all these apps, email, calendar, they've got Siri. Just connect Siri with all these apps and show the utility of a voice assistant on the phone. The phone will sell itself with the tiers, and the margins will be taken care of.
Mandeep, Mark Gurman, our colleague, said he wants to offer a dose of reality, no offense to people like you, who thinks this is going to be a super cycle, with the fact that he says that a lot of these AI functions aren't even coming out till next year, and they're not even going to be offered in places like the EU or China.
Well, so Apple obviously has this event, and then it has the iOS 18 release. That's the big one. That's where all the functionality will be deployed. And look, right now, all the Gen AI functionality is being run on the server. That's what I meant when I said NVIDIA GPUs are used for both training and inferencing. If you can do things on your phone, and Apple just has to deploy that on a chip that it owns, so it's not relying on any other third-party vendor for that chip. If it can deploy that in the next 6 months, everyone will be excited about that opportunity for the next 4 or 5 years.
This is software, though, and some analysts are talking about that actually they're more excited for the AI 17 because that will be hardware. Is that really going to be almost the holy grail of this new AI phone when you link up the software and the hardware, new look and feel?
Yeah, that's always been Apple's strength, the vertical integration, the fact that they can do everything end to end. And I think, look, they are working on a chip that can run these AI models. Obviously, the AI models will not be of the same size as those are being run on NVIDIA GPUs, but on the phone, it will be a small language model. The question is, what can it do? Can it really enhance Siri from answering just basic queries to actually doing these Gen AI functionality that everyone is using in copilots and chatbots?
That's the detail that I want. When you say, if you can do this on your phone, do what on your phone? What are we talking about doing?
Like, simple thing is prioritize notifications on your phone. So we get a lot of notifications on our phone, whether it's messages, emails. Can the AI in Siri prioritize it? Can I instruct Siri to take something off my calendar and do subsequent, like an AI agent type of functionality? So all these are basic things. Like, think of it as a very intelligent chatbot. Right now, you are interacting with OpenAI's GPT chatbot through the app that's being deployed on the server. If you can do that on your phone, you don't mind sharing data through the email or the calendar that you have because it's all sitting on your phone.
So like a personal assistant?
Yeah.
That's the direction of travel?
Absolutely.
Okay. Mandeep, thank you, sir. Mandeep Singh of Bloomberg Intelligence. Are you buying one? We all want to know. Bramo?
Well, I just remember when we first got Alexa and the kids, what they tried to do with it was see how far it could go. So they would ask as many questions. Tell me a joke. Tell me, are you married? When do you die? When were you born? All these sort of personal questions. Maybe Siri will be able to have more personality and people can, have real relationships with their phones.
Two things on Siri. When I hear Mandeep speak, all I keep thinking about is sounds like I'm going to miss a doctor appointment if I leave it up to Siri. And also, just a few weeks ago, I was talking to a guest and Siri picked up that I was talking to her. So now I've banned Siri actually from my phone because I just don't use it. I don't really think it's great.
You missed the punchline. Relationships with your phone. Is that what you just said?
Well, can you imagine if somebody's sort of, talking to their phone says, you look great today. No, you really should just keep going with it. They can give advice. It could really, support you.
I haven't given this much thought.
You should.
But okay. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Kering shares are dropping in Europe, down nearly 4%, currently trading at its weakest since 2017. Kering has been hit with 2 sell-side downgrades this morning at Barclays and RBC. Barclays noting the luxury weakness in China, saying it looks structural, not just cyclical. RBC struck a similar tone, writing that the luxury sector is incrementally softening, and Gucci will be especially affected as it transitions to new design aesthetic. Anthony Blinken is set to discuss the Middle East and Ukraine on a 2-day trip to London this week. The Secretary of State is the most senior U.S. official to visit the UK since the Labour Party came into power in July. The White House says UK Prime Minister Keir Starmer will be in Washington later this week. And Couche-Tard has reaffirmed its interest in 7&I. The Japanese owner of 7-Eleven had rejected the initial $39 billion acquisition bid. Couche-Tard said it wants to work with 7&I to agree on a friendly buyout. A deal would be the biggest ever foreign takeover of a Japanese company. And that's your brief. John.
French for night out. French for night out. Couche-Tard.
Couche-Tard? In English, it doesn't translate.
Okay. Doesn't go with the logo? It's Canadian. Doesn't make sense.
Not
the French-speaking Mrs. Ferro taught me that over the weekend, so there you go. Up next on the programme, sending the right signal.
Typically, when the Fed cuts 50, they're cutting 50 because there's a growing deceleration in the economic data. I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case.
That conversation up next. Live from New York City this morning. Good morning. Equity futures on the S&P 500 with a little bounce relative to the big loss we saw last week, up by 0.7% on the S&P 500. Under surveillance this morning, sending the right signal.
Typically, when the Fed cuts 50, they're cutting 50 because there's a growing deceleration in the economic data. This is a tricky period because you obviously have a lot of focus on the labor markets and the labor market deceleration. I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case.
So here's the latest. Traders turning their attention to CPI on Wednesday for clues on the Fed's path ahead. Friday's weaker than expected payrolls report failing to settle the debate over how aggressively the central bank will cut interest rates. Sonal Desai of Franklin Templeton saying the data do not support over 100 basis points of cuts in the next 3 meetings. I still see rates dropping to only 3.75 to 4%, absent a recession, which is not my base case. Nonetheless, it is a close call, and a dovish Fed could prefer to validate market expectations. Sonal joins us around the table. Sonal, good morning to you.
Good morning.
3.75 to 4. Where do those numbers come from? Let's start there.
Okay, so that basically comes from a view of where the neutral rate is. It's been my personal bugbear for the longest time.
You think it's higher than they do?
Yeah, I do. If I look at historically where the neutral rate has been, and if we're talking about the real Fed funds rate, it should be around 2%. That comes from a combination of 2% real and 2% inflation. You get to around 4%. And by the way, it was around that level for a good 50 years before the global financial crisis. So we're talking about a certain amount of recency bias. Nothing drives us to 0 or 1.
The obvious question would be what changed? What changed now versus, say, 2019?
So I think the obvious thing that has changed is a true return to normalcy. In the post-GFC period, I think we just went through a very extended period where people were attributing the low rates to everything from secular stagnation upwards. Inflation was suppressed. Well, inflation has reverted more or less to normal. I'm not talking about runaway inflation here. I'm talking about, inflation, no risks really of deflation anywhere on the horizon. And definitely balanced risks looking forward into the next multiple years in terms of inflation or deflation. I mean, let's not get into the whole fiscal issue because we can go down a rabbit hole there. But it's definitely stuff which is going to keep pressure on inflation. Economy is not collapsing. Look at how we've grown. With rates being where they are.
All right, so let's put aside the deficit because
I thought you'd want to go down the rabbit hole.
We would want to, yeah, but it might take too much time, and there are a lot of other things that we need to talk about. Just put that aside. We are the deficit in this conversation, but there is this concern about what you're seeing in the labor market that is more protracted weakening, and we heard from Nela Richardson of ADP that she is seeing a loss of dynamism in the U.S. labor market. How do you understand that with this idea that the Fed is not nearly as restrictive as people think?
Well, there is a loss of dynamism, and I think the critical thing is to think about starting conditions. We started from a historically tight labor market, conditions not seen in over 40 years, largely fueled by everything that went on in the post-COVID period, but it was historically tight. We kind of need to see it get back to a bit more normal conditions, and most estimates of Nauru are not 4.1 or 4.2, they're closer to 5, just saying.
Well, when you talk about the balance of risks, and this is one aspect that I find really interesting, we were speaking with Ed Yardeni, what is the consequence for markets should the Fed opt to go 50 basis points? He used to think that if the Fed cut disproportionately, that would actually cause an unsustainable boom in equity valuations. He sees equity markets, the initial response being negative, just simply because of the carry trade unwind. What do you think the longer lasting influence would be? What is the risk underpinning an outsized move?
I think the risk is twofold. One is right now, everyone assumes that the market is counting on a recession. I actually don't agree. Look at where high yield spreads are. We're at 325, maybe 350, somewhere. We've been range bound. Risk assets and fixed income are not pricing in a recession. What they're pricing in is outsized Fed moves, which I think is probably unrealistic. Now, if the Fed actually goes by 50, I can see the market pushing the Fed to continue, right? 50, 50, 50, 50, and it doesn't need to. There's an enormous risk doing it that way, I'd say. I mean, does it result in another rally? Maybe not at this stage. There are many other things going on. We don't know what's going to happen in November. There are lots of uncertainties.
Does it result in higher inflation?
Well, I don't think monetary policy in and of itself is going to trip us into higher inflation at this stage. I don't think so, unless they do something crazy. But I do think the combination of monetary policy and whatever happens in the first 3 to 6 months of next year via fiscal policy, that could.
Do you think, given the fiscal policy of next year, potentially we don't know whether or not the Fed is going to be on a rate cutting cycle or hiking?
They're not going to be hiking. Look, they're not going to be hiking. We are at a decent level. That's a very outside scenario. I do definitely think that the market pricing of rate cuts all the way down to something like 280 by the end of next year is wildly overblown unless we seriously believe they're at risk of recession. And I repeat, at least fixed income markets are not pricing in a recession right now. They're not.
But when you say you don't think the Fed is going to have to hike next year, the Peterson Institute thinks potentially they would because of things like Trump tariffs and immigration policy.
Those are imponderables, right? So I would say that there's that. You get another $1.7 trillion helicopter drop coming in the first 3 months of next year. Absolutely. They might be left in a situation where towards the end of next year, they might have to hike. It's just not my base case. My base case is that we're in a holding pattern. I think the market's overreacting right now. And I think the end point is closer to 375.4. I'm talking about the entire cycle, not end year.
So given what you believe and given where we're priced, what are you doing? We've got a 2-year down to 370, 10s at 374. You mentioned high yield spreads in the 320s. What are you doing? What are you buying?
Neutral. We're pretty neutral. We're a little bit, we're edging into duration here and there. We're looking for value where we find it. But honestly, spreads are incredibly tight if we really believe there was a recession, which is why we don't believe that's what markets are actually playing right now.
Interesting. Sonal, always one of the best. A clinic, as always, on fixed income. Thank you. Sonal Desai there at Franklin Templeton on a big rally we've seen in fixed income recently.
I'm still thinking about our discussion earlier and
Which
this
one?
idea of 50 basis points. The rate, we've had a lot. The rate cut that could be disproportionate and how it would be perceived by markets. And whether it would be a good thing or a bad thing, whether it would convey pessimism, whether it would have a sort of, negative feel, especially if they came out and they said they were really worried about the market. They'd really worried about the labor market. I still think that markets would cheer. I still think so. I still think right now people want the big cuts. They don't think that the Fed has an edge.
Sonal's point's interesting, though. Are we sufficiently restrictive or not? Torsten Slok really weighed into this debate on Friday. The lags, you could argue, are much, much longer because of the post-pandemic fiscal stimulus. We saw on the massive fiscal transfers to consumers, to households. We saw how many companies termed out their debt. We saw a lot of that last week as well. Are they just super long, or are we sitting here and saying rates weren't high enough?
I think when people look under the hood, each industry was affected completely differently, and it's very difficult to bring it together with one overarching narrative.
I heard Mike Wilson of Morgan Stanley in the pandemic talked about these rolling recessions and these rolling recoveries, and that's what it's felt like. Coming up, Jim Bianco of Bianco Research will catch up with David Vogt of UBS, Neil Dutta of Renmac, and Viktor Hjort of BNP Paribas. The third hour of Bloomberg Surveillance up next.
They need to gather in the room and think hard about, do we want to go towards 25 or 50?
I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case.
They don't want any more cooling in the labor market. So that's the argument for a 50 now. Quickly get us to neutral.
You cut 50 if you think there's a recession, but if you don't think there's a recession, you probably want to cut at a more gradual pace.
Animal spirits are alive and well, and the Fed has to be careful about that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We are 90 minutes away from the opening bell. The cash open this Monday morning, just around the corner. The third hour of Bloomberg Surveillance starts right now, with equity futures on the S&P 500 rallying 0.7%, reversing some of the losses from last week. A 4-day slide on the S&P 500. On the Nasdaq 100 up by 0.8% on a Russell of small caps, with a very, very small bounce. The week ahead looks a little something like this, dominating the concerns of economists around the world. CPI and PPI Wednesday and Thursday, the main two data points. And Lisa, we should throw in jobless claims as well into the mix ahead of next week, September 18th, the Federal Reserve decision just around the corner.
And how much has the focus really shifted to the labor market and away from inflation as the preeminent factor heading into that September 18th decision? For now, it seems like everyone very much is putting an emphasis on jobs, whether or not they really are deteriorating as quickly as some people suggest, and whether inflation really is dead. And this is something we were just talking about with Sonal Desai. What would it take to create and sort of reignite some of those inflation fears that we had just a couple months ago?
Chairman Powell sounds like a single mandate central banker right now. Do you think the rest of the committee still sound like a dual mandate central bank?
It seems like an increasing number of them are saying the balance of risks is shifting and they're focusing more on the labor market. To Mohamed El-Erian's point, though, about the single mandate, right now this market is trading as though the Federal Reserve is a single mandate. If we get an upside surprise, and this to me is going to be the key test, if we get an upside surprise in CPI, does the market care?
No Fed officials speaking this week. We're in the quiet period, 2 Wednesdays away from that Federal Reserve decision. Going into the blackout period, this is the line from Governor Waller. The labour market is continuing to soften, but not deteriorate, acknowledging that policy needs to adjust, but not exactly saying we need to go 50 basis points. That's the takeaway for many going into the weekend.
I love what Steve Risciuto just published, talking about the rate cut arms race, how economists are all coming out and who's going to outpace the other when it comes to deciding what to do. But considering inflation, he says the Fed's desire to provide monetary stimulus to an economy that is fundamentally healthy and benefiting from accommodative markets, as well as what he says excessive liquidity, will lead to stronger growth and more entrenched inflation. So maybe tomorrow's CPI actually is important.
I love how we completely failed to settle this debate. BMO's Ian Lincoln is calling now the decision on September 18th, the photo finish. Andrew Holdenhorst of Citi hasn't changed his mind at all. We are increasingly convinced the Fed will deliver multiple large-size rate cuts as the job market continues to cool.
At this point, the Fed is leaving it open, and Chris Waller did a fantastic job in absolutely settling nothing in his speech, actually keeping the door open to potentially a 50 basis point rate cut on September 18th, which is my birthday. I just want to let you know that to celebrate my birthday, I'm going to be having Fed Day. But to me, I'm just looking forward and trying to understand what data could potentially tip the balance. Is it University of Michigan sentiment survey? Because that once was really important. Is it jobless claims? These are some of the aspects that.
Do you like your birthday?
What?
Do you like your birthday?
I like Fed Day.
Okay.
I love
Sounds like you like Fed Day more than your birthday.
You mentioned that it's your birthday, so we're going to have to celebrate it now. We'll do that on Wednesday, next Wednesday.
People might confuse it, though, with celebrating a rate cut, and then that could get
No, I
awkward.
think they'll be pretty clear that that's not what it's about.
Okay.
We'll make it very clear.
We'll wear hats.
Yeah, if you want us to wear hats, we'll wear party hats. We can do that.
Thank you.
Equity futures on the S&P, positive by 0.6%. I can see that. TK, bow tie, party hats. Bond yields higher by 4 basis points, the 10-year 374.94. Speaking of the bond market, the yield curve, 2 years versus 10-year. If you're just tuning in, we've said this a few times already this morning. We are positive by almost 5 basis points now, 2s versus 10s, and had the first close in positive territory of the year so far. In fact, going all the way back to the summer of 22.
And a lot of people say, historically, when you see a renormalization of the yield curve, a sort of disinversion, it's typically a bad sign after a long period of inversion, just simply because it means the Fed is cutting steeply at a time when growth is slowing down. People are betting this time is different. Sonal Desai just talking about how no one is seeing recession, at least when you look at credit market pricing. That's ultimately the question.
Credit spreads are super tight. You'd have to agree with that. Just objectively, just an observation, credit spreads are super tight. That's not screaming recession. Brent crude, just to finish things up, WTI and Brent crude a little bit positive this morning. We're at 68 on WTI and Brent crude, just short of 72 after a big week of losses last week, almost 8% on WTI crude. Big move lower across those 5 days last week. Coming up on this programme, we'll catch up with Jim Bianco of Bianco Research, with stocks looking to snap a 4-day losing streak. David Vogt of UBS ahead of Apple's new product launch, and Viktor Hjort of BNP Paribas on why he's bearish on credit markets. Speaking of, we begin with our top story. Stocks looking to snap a 4-day losing streak following Friday's payrolls report. Jim Bianco of Bianco Research is not buying the gloom. I'm a no-lander. I still do not see a broad slowdown in the economy. The labour market is showing signs of cooling, but these may be measurement problems. Jim joins us now for more. So, Jim, let's go to the bond market first. Why is everyone bullish bonds, given what you just said?
Because the Fed's going to cut rates and they're going to lower financing costs. And we're having a debate between 25 and 50 basis points. And I might add, too, when you said everyone's bullish bonds, if you look at most of the surveys, whether you're talking about the BofA Global Fund Manager Survey or the Commitment of Traders Report, we've got some record bullishness across the board in the bond market. So everybody's positioned for a continued fall in interest rates. And usually when they get that extreme, you're very close to the end of the move.
So, Jim, you said there's measurement problems. Can you walk me through what you meant by that?
Remember that when we do the survey, when we do payrolls and we look at employment in the United States, we do surveys, and those surveys are adjusted by population growth. The population growth in the United States has exploded higher in the last 3 years or so because of migration. We've gone from about a 0.2% population growth in 2020 to 1.1% population growth, and that's a gigantic move for that. And so all these surveys are being adjusted by population growth. And you have to ask the question as to whether or not we're actually measuring it correctly. If we had stable population, the answer would probably be yes. But under this flux of population that we've seen, there's a lot of questions. And I think it really comes down to more on the household survey, where the unemployment rate is measured, less so on the payroll survey.
You're speaking in tandem with your no-landing compatriot over at Apollo, Torsten Slok, who put out research over the weekend pointing to just response rates declining, that the current population survey has gone from about a 90% response rate in 2012 to about a 70% response rate today. I'm just wondering, Jim, what gives you confidence that the lack of clarity that we're getting speaks to bullishness and not bearishness in the labor market?
Because when you look beyond the labor market, and let's take a look at consumption or retail sales has beaten the Wall Street estimate 25 of the last 31 months. And the consumption numbers are very strong, especially where they were pre-pandemic. And so what that says is that there's a lot of spending going on in this economy. Well, what's the big driver of spending is income. That must mean that there's a lot of jobs out there. People have a lot of income. Yes, the savings rate has been falling, and that can explain some of it, but not all of it. And I think what it does do is it masks the payroll report and the household survey are masking the jobs that are created that you actually are seeing in like the retail sales and the consumption numbers because of how high and strong they are.
That said, we are seeing some real weakness. When you talk to executives of retail companies or beyond, they all talk about how they are seeing more choicefulness, if you like that word. I think it's a little confusing, but that people are being more discerning in how much money they spend. Where do you place that in this trajectory of no landingness that you see?
Well, the economy, when it grows, if you look historically at all of the cycles, to use a statistical term, it has a wide standard deviation. So it might grow at 2.5%, but you'll have quarters in there where it might grow less than 1 and quarters that it grows more than 3. And I think what we're seeing with that discrimination among consumers, and especially don't forget that it's an election season too, and that has a big effect on them. that we're seeing probably more of that normal noise that you would see around an economy that is growing near or at potential. Yeah, we had some quarters late last year when we were growing at 3 or 4%. We had a very weak first quarter this year. We're looking at low twos probably for the third quarter on GDP growth. So that's kind of in the normal range of things you would see with the economy. But add it all up, average it out, and it does look like an economy that is not at risk of recession at this point.
What's the biggest catalyst, though, that could have you maybe back off this no landing scenario?
Probably if the inflation rate were to continue to move lower. Now, I'm going to, for argument's sake here, I'm going to use a year-over-year CPI. In June of 23, it was 3%. And everybody said we're on the last mile. Well, now it's 2.9. It's taken 14 months to go from 3% to 2.9, and it did make a move towards 3.7% in the middle. There hasn't been much progress in terms of inflation moving lower. If you look at like Cleveland Fed median CPI, or you look at the Dallas Trim mean PCE numbers, these I think are better core measures of inflation than ex-food and energy. Those numbers have kind of stalled out too at very high levels. If the economy is really slowing, we should see the inflation numbers continue to move lower, and we haven't. We've seen them settle out at a late rate well above where the Fed wants, and we just assume that they're going to move lower. So if they do start to move lower, then I would start to say, then there is some broad-based weakness.
So you have concern that potentially, or do you have concern that a rate cut would mean somewhat, potentially, reacceleration of inflation?
Yeah, that's my biggest concern. I'm in the camp that the new inflation rate is somewhere between 3 and 4%. And I might add, that's exactly what it's been for, as I mentioned before, the last 14 months or so, between 3 and 4%. And whether or not we get a Harris or a Trump administration after the election, it looks like we're going to have spending, we might have tariffs, and we're going to see a big fiscal response out of the federal government. You add into that easy monetary policy, and yeah, I could see where we could be looking at the second half of 25 and talking about a reacceleration of inflation, not to 9% or anything like that, but solidly staying above that 3% level and being very worrisome for a Fed that's got a target of 2% and said that they will get to that target of 2%.
So, Jim, this raises some big questions about the projections that we get next week in the SEP, the summary of economic projections. And I can share with you where CPI is right now in those projections, called PCE, 2.8% for 24, 2.3 for 25, 2% for 26. Can you share with us where you think that will be come next Wednesday and how high they'll be revised up by the time we get to 2025?
Well, I don't think next Wednesday that those numbers, for at least for 25 and 26, are going to get revised much. But the story with the Fed's SEP is always the 2-year out number is always at 2%. And then as that 2-year number becomes 1 year and 6 months, they start to revise it higher. And I think that that's going to be probably more of the same when it comes to where the Fed is. And let's remember in June, the Fed did acknowledge that there is a base effect in the inflation numbers, meaning that the seasonal data, the seasonal factors are turning positive, meaning they're going to push the numbers up through the second half of the year, which is why back in June, they upped their forecast to 2.6% for 2024. So I don't suspect we're going to see a lot of movement in the 24 number. Probably the 26 number will stay at 2% or right on their target. So, that's going to be the key, though, is whether or not the inflation rate does move down.
Jim, this was great. Jim Bianco of Bianco Research. Jim, thank you, buddy. Going into the Federal Reserve decision next week. Speaking of forecasts and taking a completely different view compared to, say, Jim Bianco, Andrew Honhorst of Citi, I mentioned him earlier. This note just dropped. This is what he's got to say. The message from the September jobs report was clear. The unemployment rate is higher than the Fed forecast and likely to revise higher. Fed officials will need to revise up their unemployment rate projections and are likely to cut rates at least as fast as markets expect. Our base case, wait for this, in our base case, delivering 125 basis points of cuts over the remaining 3 FOMC meetings this year. I assume that's a 50-50 and a 25.
I do wonder if they are going to increase their unemployment rate, just considering where they are and that the unemployment rate is above where they say that we're going to end the year. To what degree do they speak to that weakness, and how does the market respond to it? Just Jim Bianco said something really interesting. I just want to sit on that.
Said a few things.
He said a few things. The idea that lower inflation, so if we get a surprise to the downside on Wednesday, would actually challenge his view that we're in a no-landing economy and would make him think that actually maybe the economy is weakening much more significantly than he thinks.
Interesting. As Jim speaks, futures roll over. Equity futures still positive, though, by about 0.5%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. China's CPI came in overnight at the weakest level since 2021. The calls grow yet again for more effort to boost household spending. According to one measure, its economy is in the midst of the longest streak of falling since 1999. China's CSI 300 extended losses after the data, ending the session on the verge of a 5-year low. Morgan Stanley has cut its Brent forecast for the second time in just weeks. It had expected $80 a barrel in the fourth quarter, but now Martin Ratz and team see an average of $75. That's still higher than the current price of just under $72. Trafigura, for its part, has an even more bearish outlook. Speaking at a conference, the firm's head of oil said it could go as low as $60 relatively soon. And men's tennis #1 ranked Jannik Sinner took down American Taylor Fritz at a star-studded U.S. Open final on Sunday. The rising star from Italy took the match in straight sets. The 23-year-old shook off the controversy surrounding a banned substance he was found to have taken unknowingly earlier this year. The win marks his second Grand Slam title of the year. He had won the Australian Open back in January. That's your brief, John.
Danny, thank you for that. I think it's fair to say that the men's tennis recession in this country is coming to a close. Fair to say?
I should hope so. What do you
Shelton,
think?
Fritz, Tiafoe.
What caused the recession?
What caused the recession overall? Over like the last 20 years?
Yeah.
Okay, this is a long, long story. I haven't got enough time. I've only got about 30 seconds.
So do it in 30 seconds. Come on.
I think that the birth of these professionals like Rafa, Federer, and Djokovic completely changed the game. Before them, you were a specialist on any given surface. So we had these American hardcourt players, and then you had players like Gustavo Kuerten, who would only turn up for the French. Goran Ivanisevic, who would only turn up for Wimbledon and would do nothing on the other surfaces. Just something changed with those three players where they just were able to dominate across multiple services, across all the slams.
I just want to know why. Nutrition? Something in
change of grass
soil?
at Wimbledon, you know. Change the game at Wimbledon as well.
Genetic modification.
Yeah, all of that. We can get into that in a moment.
Let's do
this. This is not a 30-second response. It's much longer than that.
Carry on.
Up next on the programme, the Morning Calls Plus. David Vogt of UBS ahead of Apple's new product launch. That's next. This is Bloomberg. Live from New York City, the opening bell at 1 hour and 11 minutes away. Equity futures are bouncing and positive, up by 0.6%, following a 4-day slide on the S&P to close out Friday. Time now for the morning calls. First up, Morgan Stanley raising its price target on shares of Costco to $9.50 from $8.55 and keeping an overweight rating. The firm calling Costco a best-in-class retailer. That stock up by 0.2. Next up, B of A upgrading JetBlue to neutral from underperform and doubling its price target to $6 a share. The analyst saying recent trends in travel and fuel prices are a tailwind. And finally, Wedbush maintaining an outperform rating on Apple with a price target of $285. Analyst Dan Ives saying today's launch of the AI-driven iPhone 16 model lineup will kick off the biggest upgrade cycle in Apple's history. Heard that a few times, haven't we?
I'm shocked. He's bullish?
Is this one going to be different? David Vogt covers Apple for UBS and has a neutral rating on the stock with a price target of $236. David joins us now for more. David, welcome to the program. Let's pick up on what Dan Ives had to say. What are you expecting from this launch? And could it really ignite that upgrading cycle that so many of the bulls have been looking for now for a number of years?
Great. Thanks, guys, for having me. So I'd say first, from a product expectations perspective, we don't expect anything material today that hasn't been reasonably well telegraphed in the market. So you'll get some iPhone 16s, you'll get a new AirPods generation, you'll get some new watches. But net, we think the product introductions have been well telegraphed. In terms of the cycle, we are considerably more cautious about what the next 12 to 18 months look like. And there's a couple of different reasons. One, we think obviously the application suite is going to be somewhat limited and isn't really going to drive consumer growth. Second, there's some geographic limitations in terms of the launch. So remember, this product is not going to be launched in China, nor will it be launched in Europe. So those are the second and third largest markets in the smartphone market. So net, we don't subscribe to the super cycle market. expectation that I think the market is sort of underwriting at this point.
What would you have to see, David, to change your opinion?
So I think a couple of things. One, applications matter, right? So you need the software community, you need the ecosystem to really build applications that are going to get people excited to buy new devices. Remember, these devices are summary emails, gen emojis, some writing tools, nothing that's really going to change your day-to-day productivity. So to spend, upwards of $1,000 US or euro to buy a new device is a really tough sell when, quite frankly, there are a lot of other devices on the marketplace that have applications very similar. So we need to see a much more robust ecosystem over the next 12 to 24 months. And the challenge that Apple faces is this is the first product that they've launched in history that I can recall that's beta version and doesn't have all of the features at launch. So they're going to be waterfalled in over the next 12 months or so. So it really doesn't give the consumer really anything to grab hold of and say, I need this device today.
That's the reason why pricing is going to be so interesting at a time where margins are getting compressed by how much Apple's trying to invest and buy into the AI craze. How much do you want to see them increase prices at a time where consumers are being more discretionary and, frankly, where there is competition that also does harbor AI?
I think we're in the minority here. I don't think they can raise prices. So if you go back 2 years ago, when we had rampant inflation in the US and Europe, you had the beginning stages of the Ukraine crisis. Apple actually raised prices in Europe and in the UK by basically 100 euros and 100 quid. Ultimately, unit sales fell pretty dramatically, anywhere from 15 to 20% on a year-over-year basis in that market. So there is some elasticity. And I think Apple learned its lesson. So last year when they announced new products, they effectively didn't raise prices other than dropping the low end of a storage configuration. So net-net, despite the more robust processor, the more robust camera specs, et cetera, we don't think they're going to be able to raise price because ultimately consumers, to your point, are price sensitive right now. And I think ultimately that would impact demand.
David, given the fact that you're basically outlining that these AI functions, the Apple Intelligence is kind of being unraveled here, half-baked, what are you getting when you buy this iPhone that you don't have on your iPhone today?
So the first thing that I think people talk about is you're going to have an integration with ChatGPT/OpenAI. That said, in our view, you already have the application, so it already works reasonably well on your device. So I don't think that's a game changer. But what Apple's been talking about is functions like email summarization, writing tools, these gen emojis, which, quite frankly, we'll see how that plays out. So I think, look, when you talk to the company, these are early days. Obviously, this is the initial platform. But again, you need the developer community to really build applications and functionality to get people involved. If you go back to the iPhone 12, I'll use that as a great example. Everybody thought the 5G marketplace was going to drive huge sales. Well, we're sitting here today, and I live in Connecticut and work in New York. The ability to roll 5G out pretty pervasively has been pretty limited. So I think you need the ecosystem to really drive the applications, which will then drive handset sales. We don't think that's over the next 12 to 18 months.
And why are we not going to be able to get these functions in the European Union and in China?
So one, China, the regulator, has not signed off on it. There's a suite of considerations like privacy and the ability for the local regulators to have access. So at launch, we think, or soon after launch, we think Apple might work with a local provider like a Baidu, but that'll effectively be a Me Too product. Every OEM in China will have that functionality, so it doesn't set Apple apart. And we think, look, Europe is a tough market for Apple, right? You have the EU looking at them from a DMA perspective. There's a host of regulation. And so there's obviously friction between, we think, Apple and the EU. And so net, it's not going to be a widely distributed product. The other point, which I didn't make earlier, is this device is only going to be running European or American English. So that also limits the applications in terms of countries where this is going to be rolled out. So again, it's going to be a much smaller launch than we think people anticipate. We'll talk about what the iPhone 17 could look like maybe a year from now, but near term, we think this is going to be somewhat disappointing.
David, this was awesome. I tell you what, come back soon. After we see the launch, we'd love to catch up with you, get your thoughts and talk about what was happening next, particularly what's happening in China as well, where things are really, really soft. David Vogt there of UBS. Things are not good for Apple based on that assessment.
Yeah, especially because you don't have sort of the exit ramp of China or of Europe, especially given the fact, and his point here I think is really important about the beta, and that it's very rare to roll out something that's a beta launch and then have to have people play catch up with software updates later on, and yet here we are.
Rare is a kind way of putting it. It's not good, is it?
How do you lure people in? Does Jonathan Ferro need to upgrade to something that doesn't upgrade until early next year?
With great difficulty.
Unless it folds.
Unless it folds 4 times, as you said earlier.
Yeah. Then I buy.
4 folds and I'm in.
Totally.
Game changer. Neil Dutta up next. Live from New York City. Welcome to the program as we kick off a brand new trading week. Equity futures on the S&P 500 positive by 0.5%, coming off the back of 4 consecutive days of losses on the S&P 500 and the worst week of the year so far. On the Nasdaq, up by 0.6%. Your opening bell 1 hour away. Let's get you some morning movers with Manus Cranny. Good morning, Manus.
Jonathan, very good morning. Yeah, this time last week we were talking about record highs across the index. Some names that are really on the move. Boeing is bid this morning. It was a little bit higher. This is potentially removing some of the headwinds for Boeing, doing a deal on the docket for 33,000 mechanics and factory workers. What do you get? 25% pay rise staggered out over 4 years, a commitment from management to build new airplanes in the Pacific Northwest. If this deal goes through, it helps remove some of those issues for the new management. Dell's also up there, joining the big club again. This along with Palantir. Dell back in the S&P 500. Citi actually say, look, you can still get a little bit more momentum in this stock on the upside. Why? Because you're going to see an infrastructure spend and the PC demand, that refresh cycle coming through. So they're going to get a double uplift according to Citi as they go back into the big club. Tech is really a focus. NVIDIA is something that psychologically, I think, drives the narrative every day. We're up just 1.1%, but I want to put it in context. Down 14% last week. And what you've got here is Citi saying that this stock, and this is prescient, this stock is becoming just another growth stock, and its deceleration in the rate of forward guidance is going to have less of a profound impact on the overall trajectory of the S&P 500. That is quite the call from Citi. But here we are, Jonathan. The debate is whether there's a little bit of a move in dollar-yen or just clawing to get onto some more solid ground this morning as we kick off the trading for the week on CPI.
Manus Cranny, thank you, sir. Appreciate it. That 14% move on NVIDIA. Lisa, that is $400 billion over that period.
So I put out on X this idea that it was sort of these record swings that we saw in market cap. And I got so much hate mail, which I want to do. But the hate mail was basically, well, of course it is. It's inflation, asset price inflation. It's such a big stock. But that highlights just how significant these moves have been in market cap and how we sort of shrug them off as just sort of typical in the modern world.
That's a J&J, just sort of like gone.
Wiped off.
Just like that. It's ridiculous. The numbers are ridiculous. They're absolutely ridiculous. Manus, thanks for that. Let's talk about the week ahead. Traders gearing up for a busy week of economic data, starting with CPI on Wednesday. On Thursday, we'll get PPI plus another round of jobless claims and an ECB rate decision just around the corner as well. And on Friday, the University of Michigan Consumer Sentiment Survey. Mike McKee is with us to break it down. Good morning, Mike.
Good morning. I don't think we're going to get a whole lot of interest this week in terms of the numbers because we are pretty good, not we, but the economists on Wall Street are pretty good at forecasting inflation numbers. And right now, they're not seeing much change at all from last month. We're looking at a 0.2 gain for both headline and core on CPI, a 0.1 gain in PPI, final demand, and that doesn't change much. The headline year over year comes down a little bit, but basically what it leaves you with is the Fed in the same position as they are starting the week. They can do whatever they feel is necessary, and nothing's going to compel them one way or another. We'll have jobless claims. The forecast right now is for 229 after 227. Basically, I think economists have given up. It's just like whatever last week was, we'll add 1 or 2 until we get some kind of a change.
You come on, you're basically like, go to sleep until next Monday and come back on next Wednesday, and then we get some answers. To me, I think it actually is going to be a really important week, in part because we don't understand how low the threshold is, how low the bar is for the Fed to have an outsized rate cut, what they're looking for in terms of weakness, where things are going to matter. Is it going to be the University of Michigan Sentiment Survey and what 500 people say about what they feel the inflation will be over the next 5 to 10 years that could skew the difference? I mean, doesn't that make it interesting?
To a certain extent, it makes it interesting, and the composition of the inflation reports will be interesting. Take out energy, but the rest of it, we'll see the breadth of inflation and if it has really collapsed, as Jay Powell says, and that would be good news. The thing is that the Fed has sort of taken inflation out of the equation by saying we're there, basically, and it's going to keep happening, and we're going to get down to 2%. So it would take a big surprise to affect what they're going to do, for inflation to affect what they're going to do. Now, we hoped that jobs would give us some sort of clue as to what they were going to do, but it came out right in the middle. So nobody really knows, which makes that really interesting. Because how long has it been since we've had a meeting where we did not know what the Fed was going to do in terms of monetary policy? I mean, how many times have I sat here and you guys sit here and we all say it's what they say, not what they do? But this is going to be about what they do and what they say.
Well, you were on with us Friday when William started to give his remarks, but what was your take on Waller? Because he started speaking later, and people have read that a few different ways.
Yeah, I think he kind of left an opening there because he said we could do more if necessary, depending on the data. Well, there isn't a whole lot of data between now and the Fed meeting that's going to affect that decision. So my read was that he was saying after this September meeting, if we get data that says go 50, we'll go 50. And I think that's what he's referring to. And so we'll have to, that will make November very interesting. And we'll be talking a lot about what they say in the summary of economic projections, what their forecasts are. The dot plot will be very interesting for Wall Street. And we'll have a lot to talk about going forward because they will have started the cycle, and it's then what are they going to do?
Mike McKee, thank you, sir. And Mike's absolutely right. For the first time in a long time, we've got a live meeting on September 18th at the Federal Reserve. Let's cross over to Neil Dutta of Renmark. Neil joins us now. Neil wrote this piece over the weekend on LinkedIn. You can access it yourself. Go and search for Neil Dutta. We've pulled you a quote. Neil, I want to share the quote with our audience and get your response to it. I'm seeing a lot of wildly optimistic takes out there. Almost feels like people are allowing a political narrative to cloud their analysis of the data. The fact is conditions are getting worse, not better. There will be a time to be bullish. I'm not sure now is the time. The Fed should go 50 when they can, not when they must. Now, Neil, the obvious thing to jump off the page there's a couple, but the political one's interesting. What is your view on that? Are you suggesting that there's some economists out there, maybe even Fed officials, that have got a political narrative? What's that line about?
Well, not Fed officials really, but, certain economists on the street are sounding like that. I mean, the same folks that told us, we're at a sustainably higher run rate for employment with 200,000 because of immigration, and now all of a sudden telling us that, well, don't worry about it, 100,000 is fine because that's what full employment looks like. I mean, it's a bit ridiculous, don't you think?
Well, hold on a second, Neil, because this is actually something that I've given quite a bit of thought to. Are you accusing the current status quo opinion on Wall Street that recession is not imminent as a political construct designed to help the incumbent Democratic Party?
No, I don't think. Well, I mean, I don't think that that's the accusation. I think that there are certain quarters of people that, I don't know, maybe they're jockeying for jobs in the administration. Who knows? I mean, but I do think that there's I mean, look, no one needs to talk to me about being optimistic. I'm one of the most optimistic people historically that's been on the street.
Me too.
But you can't help yourself but wonder, these wildly optimistic takes seem a little bit out of place. I mean, this notion that, this is a soft landing, this is boring, things are good, hooray, we're at full employment. I mean, at the end of the day, up is up and down is down. Okay, I mean, it's really that simple.
Okay, but what is sort of the base case, Neil, that you're talking about here in terms of where people are getting it wrong? How bad do you think it actually is? And why do you then think that the Fed should go 25 basis points rather than 50 basis points, even though everyone on the street doesn't seem to think it's that bad?
Well, I think things are getting worse. I mean, at the end of the day, since Powell talked about we don't seek or welcome further cooling in the labor market, literally every single labor market indicator that's come out has been worse than expected. ADP, the non-farm payroll number, job vacancies, the regional manufacturing employment indicators, the ISM employment indicators. I mean, the labor differential from the Conference Board. Literally, you can go on and on and on. And, we're told to say, oh, well, don't worry, layoffs are low. As if that's a leading indicator of the labor market to begin with, which it's not, by the way. I mean, the hiring rate has collapsed. I mentioned immigration before. Look at college unemployment rates, the unemployment rate for people with a bachelor's degree. That's 0.5 percentage point higher than it was the same month in 2019, right? So how does immigration explain that? So I think it's a little bit, off-putting, frankly. And to the extent that, I think the important story is that I think the economy is evolving in a way that the Fed may not be anticipating. And to the extent that that's true, I think it creates the risk of an accident later, which is something we've been arguing, obviously, since June. And the only reason to expect 50, and yes, I still believe that a 50 basis point rate cut is possible at the September meeting, that's our call to our clients, is because of Jerome Powell. We can talk about Waller, New York Fed President Williams. All Jerome Powell needs to do is get out there and before his colleagues around that table and say, I think we should go 50, and they'll all fall into place. And in fact, a lot of the people on the street that have 25 basis point rate cut calls, they'd have no problem with the Fed going 50 either.
But Neil, how political could it be for the Fed to go 50 if Jerome Powell is the one almost dictating it, not a consensus building from the ground up?
I mean, I think that a consensus would come around to the chairman. I mean, Emery, if they didn't go 50 and they only go 25, and that potentially fuels bets that the Fed will be behind the curve later, and then we're talking about even larger moves after the election, how would that not be political? I mean, to me, they have full clearance to go 50 as it is. And I do find this sort of argument, well, if they go 50 to start, it would be a panic. That would be a panic move. Well, by that logic, maybe they shouldn't go at all. Show much confidence to the market that why not just not do anything then?
Neil, we know you think they should go 50. What do you actually think they will do?
I told you, I think they will go 50 because I think Jerome Powell is going to give them license to go 50. I think he thinks that they should go 50.
So, Neil, let's build on that. The kind of communication you're expecting September 18th, together with the signal we could get from the projections in the SCP as well. Did they characterize that as a mid-cycle adjustment, a rush to get to neutral? How do you think they'll frame that move?
I think that they'll go 50 and they'll say that they're willing to do more so long to stabilize the labor market. That's how they'll frame it. They'll say that the inflation story is over, inflation has been quelled, and we'd like to stabilize labor market conditions at our estimates of full employment.
Will you feel better if there's dissent on the FOMC?
Yeah, I mean, I do think that the consensus building nature of the Fed historically creates an institutional bias for them to be late. There are lots of central banks all over the world that have more dissents. And, you know, I mean, who are we really I mean, if you're Jerome Powell, I mean, to me, it's like, okay, someone's dissenting. So what? I mean, who cares? I mean, some of these people that will dissent have been absolutely wrong about the overall tone of the data for the last 6 months. I mean, if Mickey Bauman dissents, is that really a big deal? I mean, to me, it's like, I mean, it's like being, kicked by a lesser than. So I think it's sort of not really worth trying to build consensus in that regard, especially when they've been wrong about the overall slope of the data. I mean, some of these people also have been completely head faked by Q1 inflation, right? I mean, so
true.
Look, so what's the point of building consensus with people that have been absolutely wrong about the overall slope of the data for the last, 3, 6, 9 months?
Now you've said it, whoever dissents, we're going to say they're auditioning. Neil, thank you, sir. Neil Dutta of Renmac, appreciate it. Just a clinic, as always, from Neil. Viktor Hjort of BNP Paribas joins us around the table. Viktor, just to build on that, Neil's worried about the economy, the labour market specifically, thinks they should go 50. You're bearish on the credit market. Did a lot of that resonate with you?
I think, for sure, the theme that we're moving away from rates risk being a big part of fixed income and credit markets towards ratings risk, meaning fundamentals and downgrade risk and that sort of stuff. That, I think, is absolutely a theme. Maybe I'm a little bit less worried about the labor market than he is, and probably for the simple reason that I don't really see why companies need to shed labor. Corporate profit margins are very high, haven't rolled over, and typically it's the rollover that precedes shedding of workers. That hasn't happened yet, so I'm not entirely sure why I should be too worried about layoffs. But for sure, the credit market right now is very focused on the idea of high rates and still a bit of inflation, and probably have a lot more room to be surprised by more sluggish growth.
Put some numbers on that for us. So high yield spreads in the 320s at the moment. What do you think is fair? What kind of spread widening are you anticipating?
So between now and, say, over the next couple of months, I think, 50 basis points wider. I think you can easily test the wides of early August. But I don't think it's necessarily because the growth is slowing. I think it is because we have that political event in early November, and that I think requires a bit of risk premium.
So just extrapolate that out. What does that risk look like? Is this worry about tariffs? Is this worry about just worry itself? I mean, how does this sort of percolate out into wider credit spreads at a time where companies have refinanced? And if you believe it, the economy hasn't fallen into recession.
Yeah, I think it's really about uncertainty. So, when you look during past election cycles, you very often have sort of risk-off periods during September, October into the election, and then big rallies coming out of that election. And they look different from one election to another, and the drivers are different. But one thing that you very, very clearly see most of the time is that there is position squaring going into the election. The net longs go down from mid-September through October and into the election. And that's an interesting story, right? Because what it basically tells you is that uncertainty is a factor here. If you are going into a very binary event, risk managers, to traders, to portfolio managers, tap them on the shoulder and say, hey, why expose our portfolios to some scenario that we're not 100% sure that we can quantify? Why don't we just reduce risk and then put it back on after the election? And I think that story resonates with 2024 as well. You got two candidates that are very, very different. Why should I guess whether, net income is going to go up 70% or down 7%, depending on what corporate tax rate I guess? I probably should just reduce risk and see what happens. And I think that's exactly what will happen. And that means less liquidity and a weaker market sentiment over the next couple of months.
You deal with a lot of clients from around the world, and I'm wondering how true that is, particularly for international buyers of credit, which have traditionally been some of the biggest buyers, particularly of investment grade, and I'm thinking of the Japanese and others.
We have a very interesting story, which I think relates back to some of the stuff that happened in early August with Japan. Obviously, if you have a BOJ that is hawkishly hiking rates and a Fed which is dovishly cutting rates, at some point the economics for Japanese investors to buy into US dollar investment grade debt it deteriorates. And so that's clearly an angle. I'm not sure it's the main angle here, but we saw sort of a test run of that risk scenario in early August, and I think it can happen again.
Ed Yardeni was on earlier, and he was talking about new highs for the S&P 500 after the election because of gridlock, not because of a sweep of either party. Is gridlock also good for the credit market?
I think so. In fact, I think it's probably the best outcome, right? So credit, even less so than equities, is sort of really hugs the lack of volatility type of environment. That's really, high certainty, low movements. That's sort of the ideal environment for the credit market. So gridlock is fine, but I don't think that markets necessarily anticipate gridlock ahead of the event. So, maybe a sweep is fairly unlikely, but if we add up the probabilities of a blue and a red sweep, we end up somewhere around 45% or so, right? So that means that there is at least if you share BNP's thinking, a pretty high chance that there's going to be some extreme outcome. And I think it sort of furthers this idea that people will choose not to second guess it and simply reduce risk ahead. And that, I think, points towards volatility in credit markets.
Sal, and ask questions later. Viktor, thank you, sir. Viktor Hjort there of BNP Paribas, bearish on this credit market. For the equity market, positive by 0.6%. The opening bell just around the corner. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Brown University trustee Joseph Edelman has resigned in protest against the school's upcoming vote on divestment from companies linked to Israel. Edelman had been a trustee since 2019 and is the CEO of Perceptive Advisors. In an adapted version of his resignation letter published in the Journal, he said holding the vote was morally reprehensible and rewards violence and anti-Semitism at Brown. Brian Niccol begins his tenure as Starbucks CEO today. He joins after spending 4 years at Chipotle. Starbucks shares had soared 18% after it named him CEO back in August after 2 consecutive quarters of sales slumps. Niccol and his team will be charged with reversing slowing sales both domestically and in China, long waits and labor relations as union efforts grow. And the NFL season is officially underway, and already the Super Bowl in February has its headliner. Kendrick Lamar was announced as the performer for the halftime show in New Orleans. Lamar previously performed at the event back in 2022 in a lineup that featured Dr. Dre, Snoop Dogg, and Eminem. It's been a landmark year for the rapper. His highly public feud with Drake dominated headlines and led to further critical and commercial success. And that's your brief, John.
Danny, thank you. We'll see you tomorrow morning. Thanks for this morning. Up next on the programme, Apple's product launch. Later on today, we'll catch up with Bloomberg's Ed Ludlow, live from Apple HQ in Cupertino, California. "38 minutes away from the opening bell. Equity futures on the S&P 500 positive here by 0.6%. Coming up this week, your agenda looks like this. Later on today, Apple unveiling its latest lineup of phones, watches and more. Tomorrow, Vice President Kamala Harris and former President Donald Trump facing off in their first debate, and maybe only one. Wednesday, the Fed's next big data point, its US CPI. On Thursday, we'll get PPI. Another round of jobless claims and an ECB rate decision. And on Friday, UMich consumer sentiment. Joining us now from Apple Park, our good friend, Bloomberg's Ed Ludlow. Ed, this is an odd one, and we'd love some colour from you. This feels like unveiling something that doesn't exist yet and might not exist for a number of months, maybe even quarters. Can you walk us through how odd this product unveiling actually is?
Yeah, that's an accurate framing. I mean, the most bullish on the street see a super cycle, right, where they believe tangibly the consumer is ready for artificial intelligence on device. But the plan is as follows. We'll probably get 4 variants of the iPhone 16 generation unveiled today, and they'll start shipping at the end of this month. But as is now well documented, the supporting software through iOS 18.1, in other words, the update that gives you access to Apple's artificial intelligence tool, is staggered, delayed into October. And so there's actually a really interesting element of sort of misunderstanding. For example, the bulls on the street who see the super cycle are very excited about handset upgrades in China driven by enthusiasm for AI. But as you discussed with your guest earlier, Apple is not making Apple Intelligence available in China in the first instance pending regulatory approval.
And it is sort of this curious thing. How do you unveil software? It doesn't have the same sort of sexiness as something that folds or something that's got new corners or whatever usually the hardware that they unleash is. How are they going to make a software update that you can't get until next year sexy?
Yeah, I think the story for everyone around the world is, if I'm an everyday consumer, how do I actually use this technology? You know, the beta version of iOS 18.1 has given us a clue. It's text summarization. Some of the reporting from Bloomberg is that it's the image or image generation functionality that's delayed. A lot of that plays itself out on social media, right? It's pretty easy now to create a meme. I had dinner with a let's call them a tech CEO last night, and what I found so interesting is, again, Apple Intelligence isn't going to be released in the first instance in Europe out of concern for some of the regulatory pressure there. But actually in Europe, the consumer isn't as interested as they are. It's easy for me to sit here in Silicon Valley. Literally, I have every generative AI tool under the sun installed on my phone, but that's culturally in line with what goes on here. There's a simple story that needs to be told in markets around the world. This is how you use AI on your device daily, and this is how it will impact either your work or your personal life.
Ed, looking forward to your work and looking forward to catching up tomorrow morning. Look out for Ed a little bit later, a special from Apple Park on the unveiling from Apple of the iPhone 16. Bloomberg's Ed Ludlow. Ed put it perfectly. Very, very simple terms. They need to demonstrate what this actually is now. Without just saying AI on repeat, what can you actually do with this that you couldn't do before?
How do they make it appealing, this idea of just how this can transform your life? If they can show an easy way to make this your personal assistant, that could potentially be transformative because some of us might need organization.
But the rollout is going to be staggered. It feels like a litmus test almost for these AI functionality. And Ed had a great point. He's sitting in Silicon Valley. Everyone's excited about this. They can't even break into China or the European Union. So basically, they're only going after really American consumers.
Reminds me of Tesla. It's like buy the hardware and I promise you the software update's coming.
Yeah.
It's around the corner.
It'll drive itself. It'll also serve you drinks.
Yeah, all of that.
Yeah.
There's a lot of similarities. Well, don't know about the drink serving while you're driving. I don't think anyone wants that.
You're not driving.
True.
So, anyway, carry on.
How's that going to work?
I don't know.
Yeah, it's an interesting point, isn't it? Got us thinking now, Bramo.
Well, good. I'm glad.
From New York City, this is Bloomberg.